New York City, I'm Shauna Smith alongside Madison Mills. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolios. We're tracking early session volume while bringing today's top market themes and elevating Yahoo Finance's most popular newsletter.
And happy Wednesday, everyone. Stock futures muted this morning after the S&P 500 closed at another fresh high on Tuesday after shrugging off that hotter than expected inflation print. So now investors looking ahead to more data, including producer prices and retail sales numbers.
And we are awaiting big news from Capitol Hill today. The House is set to vote on a TikTok bill that could have a massive impact on social media giants, could actually potentially ban TikTok. So let's get right to it. The three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Rick Newman, and Akiko Fujita have more.
Thank you, Shauna. Stock futures are taking a breather this morning following a market rally that pushed the S&P 500 to yet another record high close. Among the stocks leading the charge is NVIDIA. 2 days of losses have been snapped, closing over 7% higher and continuing to surge in pre-market trading.
The Biden-Trump rematch is official. Former President Donald Trump and President Joe Biden have both clinched their party's presidential nominations, formalizing what many voters figured was an inevitable rematch. The general election is now pretty much underway, with immigration, the economy, and inflation among the top concerns for voters.
And the U.S. House of Representatives set to vote on an unprecedented bill that could lead to a TikTok ban. The bipartisan bill would force TikTok's China-based parent company ByteDance to divest the popular app or be banned in the U.S. This bill has big implications for social media giants as well as any foreign-backed company operating in the U.S.
Getting to our top story, the market taking a breather this morning. Stock futures look mixed here, just about 30 minutes ahead of the open after notching another record high yesterday. All three of the major averages finished in the green. The Nasdaq was up 1.5%. NVIDIA was a massive driver in yesterday's market action. Now shares giving back some of those gains in the pre-market, off just about 1%. The stock closed up more than 7% yesterday, recovering nearly all of its losses from the two-day sell-off that we saw play out before. So for more on what this means for the broader market landscape and how to play the tech sector, we want to bring in Matt Maley. He is Miller Tabak's Managing Director and Equity Strategist. Matt, it's great to have you here. So talk to us just about how you think tech specifically is positioned at this point and what you make of the fact that the S&P has notched 17 record highs since the start of the year.
Yeah, it really has been a relentless rally here, and that's great. But of course, we always know that there is no market moves in a straight line, and at some point soon, I think we're getting ripe here for a little bit of a pullback. I mean, if you look at some of the on the technical basis, you look like the SMH, which is the semiconductor ETF, that is the most overbought on its relative strength index. It's a weekly relative strength index RSI chart. It has been in many years. In fact, it's about equal to the most overbought it's been in a decade. And the same thing for NVIDIA, which is the most overbought on its weekly RSI chart ever. Now, remember last year, NVIDIA had an unbelievable year, one of the best years for any stock ever, and yet it still saw a 20% pullback before it rallied further. So again, I'm not saying that we're seeing suddenly at a major top here, but I do think we're at a level where we're probably going to see some sort of a pullback soon, especially with interest rates starting to inch back up again.
Matt, zeroing in on NVIDIA, what causes these slight pullbacks like we're seeing today? And then what causes the quickness of the recovery that NVIDIA seems to have every single time?
Well, I mean, it's just this. It's kind of the Pavlov's dog. It's just every single dip has been bought immediately, and at some point soon, I think that's going to change a little bit. Again, we have whether it's something that's very overbought on a technical basis, but we have a lot of tech stocks that are getting quite expensive. I know Nvidia. I mean, and it's 37 times forward earnings after its most recent rally, but it's also 37 times sales, so that it can still be considered expensive. More importantly, though, I mean, I understand that the issue that where people say NVIDIA is still fairly valued, but Advanced Micro Devices, SMCI, Microsoft, they're all very expensive on a historical basis. So I think at some point soon we have to pull back, and that will be normal. That will be healthy. But I do think it's going to be something that's going to last more than just a couple of days and just a few percent.
Matt, what do you think of market sentiment right now? Because when you take a look at the reaction that we saw play out in the market yesterday, we saw another record close here for the market despite that hot inflation print that we got before the bell. Is the market a bit too optimistic still that the Fed is going to cut in June?
I think so, yes. And again, it's when you talk about sentiment, we have some sentiment readings, the AAII report, which tells us about individual bullishness amongst individual traders. But also just look at the way everybody's saying that, yeah, but. I mean, that's the argument I keep hearing. The market seems somewhat expensive. Yeah, but it's not as big as a bubble as it was back in 2000. That to me is very concerning. I remember that same argument being made back in the beginning of 2022. I mean, just because a bubble isn't as big as it is as the biggest one of all time doesn't mean it can't pull back. And to be honest with you, I think it would be healthy, normal and healthy for the market to pull back, because if we ever do get to that kind of a bubble kind of thing that we saw 25 years ago, that's going to present some major problems. So I do think that investors need to be very careful about chasing some of these names up at these levels.
Matt, how big of a pullback are you expecting?
I think we're going to see a full correction. I think we'll see it go pull back about 10%, much like we did last year. Remember, we saw that. It's the same type of thing. Interest rates last summer were moving higher. No, the market completely ignored it until it didn't. And then finally, by August, they started paying attention, and sure enough, the market saw a 10% correction, even though it obviously has gone a lot higher since then. I think we're seeing the same thing now. The market's ignoring those higher interest rates recently, but I think that once it now that they're starting to tick back up again after yesterday's inflation report, they're going to have to pay attention to it more. And the other thing I would just say is that once we finally see a dip of more than just a couple of days, we see more than 2 to 3%. People know that there's some froth in the marketplace. They'll start to take some chips off the table. So I think 2 to 3%. If it suddenly becomes a 5% correction, it will quickly become a 10% correction, just because of the unwinding of some of this froth.
So then, Matt, what is the event that causes that correction to come?
Well, we don't always need a specific event, and we certainly didn't get that in 2000 when that. Well, again, I'm not calling for a major top like we saw at that time, but sometimes things can just roll over. But I am concerned about, number one, this situation with the interest rates moving higher. Number two, we have this meeting on Monday. This is, NVIDIA's having their developers conference. And do we get a sell the news reaction to that? I mean, this could be the thing that could take it even higher. So I don't want to, so people don't get short here. That's not what I'm saying. I'm just saying be careful about chasing. But again, remember what happened last year with NVIDIA's earnings. In May, they reported really good earnings, and the stock just exploded higher for another couple of months. They reported just as good in numbers, even slightly better in August, and yet the stock got a sell the news reaction where it rolled back over, again, because interest rates were moving up a little bit. So be careful. We'll see what happens early next week to see how to react to this developers conference that starts on Monday.
I've heard people describing that developers conference already as a festival for AI. So I'm thinking it's probably going to be a bit of a more to come for the rally there, Matt, but really appreciate your insights there. Thank you so much, Matt Maley, for joining us early this morning here. We're going to move on to another asset here. Bitcoin surpassing its record high this week, notching a fresh record of 73,000 after a roller coaster week for this volatile digital currency, to say the least. To break down Bitcoin's moves for us, we've got Yahoo Finance's very own Jared Blickery here. Jared, what are you seeing?
Well, another record high, and let's look at the price action over the last 5 days. Here we did. Over the weekend, we came in to the week at about 68,000. We took a little bit of a dip Monday, and then we rallied to just short of 72,000 or so. And then we sold off all the way down to 69,000 yesterday. A rather dramatic reaction, it looked like, to CPI, but now we are back at these fresh records. And just looking at a longer term, this is a 5-year chart where we can see these these record highs in the rearview mirror now. A lot of people ask, okay, well, now that we're at record highs, what is the target? You have big round psychological numbers, so 100,000 is a real easy target. There's all kinds of ways to come up with Fibonacci extensions and other methods with measured moves of coming up with higher highs that are potential higher highs than existing prices, but probably save that for another day. What I do want to show you is what's happened in the crypto market over the last 7 days. Here we have Binance token, left for dead, but up 25%. Got the settlement with CZ probably in the rearview mirror. Algo's up 14%. Litecoin having a great week, 10%. So my point is, it's not just the big guys like Ethereum and Bitcoin that have been surging recently. It's a lot of other stuff here. And that was something that was missing in the run-up in Bitcoin last year. We did not have that broad participation. Now, Ethereum, this is a 5-year chart similar to Bitcoin, but it has not yet taken out these record highs. 4,500 is the big number, although it did pop a little bit above that. And finally, I just want to show what's been happening with the Bitcoin ETFs. This is a huge new asset class, and I'm getting reminders of that back when GLD, that is the first gold ETF, launched in 2004, very similar time. Before that, there was not a good way for retail investors to get into gold. You could own physical gold, you could do some other things, but for the most part, the ETF made it mainstream. This is saying here, 2 of the top 5 ETFs in terms of flows this year in the United States are Bitcoin. And we're talking $10 billion for IBIT. That's the iShares Bitcoin ETF. And then the Fidelity one, $6.2 billion. These are just high numbers. And in my opinion, it's difficult to see it not increasing from here. There's just a lot of momentum behind this sector. And so my ETF analogy remains. GLD is to some of these ETFs now.
Jared, it's so interesting to see Bitcoin and gold moving at the same rate here.
Record highs for both.
What's going on with that? We're going to continue to cover that throughout our show. Jared, thank you so much, as always, for giving us your insights there. We're going to move over to D.C. for a bit because President Biden and former President Donald Trump will officially square off in a rematch for the 2024 presidential election after securing enough delegates to become their party's nominees. Yahoo Finance's Rick Newman joins us with the details. And Rick, I want to talk about the market reaction here. Hello from you and your Adidas Sambas, as always. What does this mean for markets? Is the race going to have much of an impact, or is it really about pricing and the potential outcome?
I mean, markets saw this coming. This is the rematch everybody foresaw and nobody wants. So there's no surprise here. And markets have other things on their minds right now. Investors do. But when we get to within 6, 8, 10, or 12 weeks of Election Day, there are some major issues on the table here, depending on who the winner is. Corporate taxes, individual taxes. Are we going to have another Trump trade war with him saying he now wants to slap more tariffs on imports from every place and even larger tariffs on imports from China? Different attitudes toward immigration. Trump recently said he would consider entitlement cuts, which means that perhaps trimming the benefits for Social Security and Medicare, and many other things. So this is actually, I mean, all the political geeks are all talking about, the future of democracy is at stake. Well, whether it is or isn't, there's a lot of money at stake too, depending on the outcome in November.
There certainly is. And Rick, let's talk about what is playing out in D.C. today, because when we look ahead to the election, we've heard both sides of that, but specifically Donald Trump talking about social media and how that played, or how he views that played into the results of 2020. But they're voting today, the House is, on a TikTok ban. If that goes through, how big, I guess, what are the 2024 implications then? And then also when you see a name like Rumble being a top trending ticker here on Yahoo Finance, what do you think the odds are that it will be divested versus an all-out ban?
Well, a long series of questions there, and this has been a sleeper issue that suddenly has been propelled to front and center. So this is what's going on with TikTok. So first of all, Trump tried to ban it by executive order when he was president. Court shot that down. So the assumption was, yes, Trump would try to ban it again if Congress were actually to pass legislation. But now Trump says, no, maybe we shouldn't ban it because it would just give the other social media apps that he dislikes more market share. And that comes after he met with Jeff Yass, who is a billionaire investor who owns part of TikTok. So Trump now apparently is not so much in favor of banning TikTok. Joe Biden joined TikTok in January, and he has since posted something like 60 videos there. That's his campaign, obviously trying to appeal to young people with these sort of snarky videos. But Biden says he would sign a bill to ban TikTok, so he would wipe himself off. Okay, so what's really going to happen here? So the legislation could pass the House. It's going to face a harder track in the Senate. Let's call it 40% likelihood that this so-called ban, would actually pass Congress this year. That's before the election in November. Biden now says he would sign that, but really important to keep in mind, the main point of this bill is to force the sale or divestiture of TikTok by the Chinese owners. In other words, they sell it to somebody who's not based in China. Right. And they have to have the punishment if they don't do that, which is the ban. The main goal is not to ban TikTok. And if this legislation actually becomes law, the most likely outcome is it forces a sale rather than TikTok just disappears. And by the way, if TikTok disappeared, some number of millions of voters would punish whoever they felt was responsible for that. And if Biden's the guy who signs the law, I mean, they would punish him.
What is the appetite, though, from China to allow that sale to go through seems to be the big question, because whether or not that's what Congress decides, China's still in control.
So it's kind of an open question, like how much does the Chinese government actually control TikTok? I mean, the Chinese government is not the owner of TikTok. The owners are based in Singapore, I believe.
But
and so people in the intelligence community and elsewhere say, well, the nature of any company in China is that when the Chinese government asks you to do something, you do it. So let's say that assumption is true, then the Chinese government wants a Chinese entity to continue to own TikTok because whatever it might do, propaganda during a crisis or a war over Taiwan or something, it wants to have that leverage. So they're going to oppose this, but I mean, they can't stop it if there is enough momentum in Washington to make it happen. And again, just to remind everybody, if this law happens, the most likely thing is just a sale of TikTok, and TikTok continues to operate as everybody knows it, rather than it just gets shut down. I mean, I guess there is a 2% chance that the ban actually goes into effect and TikTok is shut down. But if you're the owner, you'd just be leaving tons of money on the table. Like, why would you do that?
Yeah, and TikTok vowing to legally fight it if it does pass the House and Senate, and of course signed into law. So we will see how this all plays out. The House voting today, starting at 10 a.m. Eastern time. Right, Rick? Thanks.
Bye, guys.
Well, coming up, Dollar Tree shares sinking after announcing it's closing hundreds of stores. We've got to look at the top trending tickers next. Today's stock to watch is Southwest. Shares moving to the upside, up just about 0.4%. Jefferies upgrading the airline to hold from underperform, raising its price target to $28 a share, right around where it's trading today. That's up from $20 a share, saying that the move to the downside that we saw yesterday, they, at least in their view, finding a floor right now in the stock price. But Maddie, we got to go back to really what played out yesterday and how that then plays in to this call today, with Southwest being a top trender on Yahoo Finance now for the second day in a row. We got the warning yesterday. Executives were speaking at a conference here, just warning about the delayed deliveries here from Boeing and what that means for their business, and saying that it's going to have a real impact just on capacity and their routes that are available here this year and going forward. So it's going to be an issue here in the current quarter and for several quarters. So we saw Southwest have its worst day that we've seen in just about 4 years. So because of that drop, now Jefferies a little bit more constructive on the current valuation of the stock.
Well, it's really interesting reading through the Jefferies note, because they see the lack of deliveries from Boeing as potentially a boon for a company like Southwest, because it frees up a little bit more cash for them, right? If those MAX aircrafts are not going to be able to get delivered, that frees up a little bit of cash for a company like Southwest that's been struggling with their cash flow. Also interesting in their note, they talk about potential pressures for the U.S. consumer, and they cite student loans as another headwind for consumer spending on flights moving forward. And I find it interesting that we're still continuing to see folks across the street citing that as a potential headwind here. And then when you look across the board, it does look like Southwest, one of the only airlines up this morning, potentially off of that news, and one of the reasons why they're probably one of our trending tickers on the platform this morning.
Yeah, certainly. I'm trading to the upside there. But we're seeing a mixed picture for airlines here for a second day in a row, following much of the pressure that we saw yesterday. Many of those names in the red.
Right. And we've got some more trending tickers here on Yahoo Finance as well. We have Eli Lilly announcing a partnership with Amazon's pharmacy arm, TruePill, to deliver prescriptions through its direct-to-consumer channel, Lilly Direct, which launched back in January. We see here in the pre-market trade, Eli Lilly and Amazon both up on the news. Eli Lilly up just 0.4%, Amazon up 0.3%. So continuing to see news about these partnerships coming in with Amazon. This is just the latest to be announced here in a string of partnerships. And another piece of good news for Eli Lilly, which has been finding kind of ways to recoup some financing over the past year and kind of rebrand as well.
Yeah, certainly. And when you take into account the sheer demand that they've seen for their drug tied to weight loss here, and exactly what they are trying to do in order to do everything they can to meet that demand, this partnership will, you would think, help them deliver Zepbound in a more timely manner. So this could have a real material impact to their bottom line going forward. What was also interesting was some of the commentary that we've gotten from executives here over the last several days. Now, they're saying that they're looking for more partnerships potentially, even potentially looking at a retail pharmacy to offer a pickup option. And then Walgreens CEO Tim Wentworth weighing in an interview with Reuters, saying that Lilly Direct was launched at the pharmacy chain, could be, quote, a very natural potential partner for someone like Lilly. So we certainly are seeing some disruption within the healthcare, within the pharmacy space. So the fact that Eli Lilly now has a direct offering to consumers, partnering up with a behemoth like Amazon, you would think would really help them get their medications to patients in need and also do it in a much timelier manner.
And definitely a boon for both of them, it seems, in the pre-market. But one of the names that's a trending ticker this morning, not doing so great. We're looking at Dollar Tree sinking in the pre-market after giving weaker than expected full-year forecast, also announcing plans to shut down 600 Family Dollar locations in the first half of this year. More broadly, Dollar Tree is planning to close about 1,000 stores in this move to improve their profitability. One of the things, though, that the CEO is citing, and we've heard this from a lot of executives throughout the course of this earnings cycle, is freight rates coming down. So that, to me, is an indication that maybe more broadly we could see some inflation easing as retailers start to get a little bit of pressure taken off the pedal there when it comes to freight rates. That could be something that leads to profit margin increases without having to push up prices for consumers. But I'm also just interested, given the inflation picture we're in right now, that we're not seeing a name like Dollar Tree performing a little bit better. You would think typically this is a name that would do well in a trade down environment when consumers are feeling a little bit of that inflation pressure. So I'm curious to see what happens with that moving forward.
Yeah, we're going to be learning a little bit more on the call just in terms of those future plans and exactly what that looks like here for Dollar Tree. Maybe a bit more color just about their store traffic and how they see that playing out for the remainder of the year. You take a look, though, at a one-year chart. The stock's still up just about 5%, but you're right, far underperforming what we've seen more broadly speaking within the market year to date. We're also still looking at some gains here, but that drop here in the pre-market, just about 13%. They are seeing some weakness within their business. They are seeing reason to shut some of their stores, their brick and mortar print, their approach there, their strategy, they're shifting as consumers change the way that they shop and change the way that they get some of their consumer staples brands. But I do agree with you. You would think foot traffic through these stores would really be through the roof compared to the levels that we saw just a few years ago, given the fact that Americans are still under a tremendous amount of pressure from higher prices on many of their staples.
That's exactly right, Shauna. And I'm just looking, too, because you're mentioning trade down. It makes me think about a Walmart up 15% year to date. So when you compare that to Dollar Tree, obviously seeing bifurcation in that performance there. Dollar Tree up 5% year to date, but still struggling in comparison. So maybe some market share taking from Walmart.
Yeah, and we'll see. Dollar General is reporting on Thursday, tomorrow morning before the bell. So we'll get some comparisons there and see if we're noticing any trends in the through line with some of those discount stores. All right, well, coming up next here on Yahoo Finance 18, we've got the opening bell in just about 3.5 minutes. We'll be right back. And there's the opening bell on Wall Street. You can see the excitement playing out at the floor of the New York Stock Exchange and the Nasdaq. Stocks coming off another record-setting session here for the S&P. We're not seeing too much action, not drifting too far from the flat lines here at the open. As we're looking at a mixed picture, technology, which was an outperformer yesterday, some of those larger cap tech names taking a bit of a breather at the open. Jared Blickery standing by at the Interactive with a closer look at some of the movement that we're seeing. Jared.
Speaking of movement, I just had to reset the Interactive here. Not quite ready for business, but I will get to that in a second if we had some time. Give me some direction. But we are coming off a record high in the S&P 500 from yesterday. We saw tech. Tech was the leading sector yesterday, so we're going to see if it bounces back today, but it has been lagging. That's where it was in the pre-market. We'll have to get a sense of what the bond market is doing. And I'm going to toss it back to you, Shauna, and maybe we have time to get in some heat maps in a little bit.
Yeah, certainly. And Jared, taking a look at the sector action here that we're seeing play out this morning, I mentioned the fact that technology under a bit of pressure. You have a name like NVIDIA, which soared in yesterday's session up just about 7%, giving back some of those gains. And Maddie, you and I have been talking about this record-setting rally. Matt Miller over at Matt Maley over at Miller Tabak joined us at the top of the show, talking about the fact that he actually thinks the market is set up for a possible correction right now, given the massive run-up and given the current valuation of some of these larger cap tech names.
Yeah, and it's interesting to see what the market is doing this morning because, you know, after that hotter than expected inflation print yesterday, it was weird seeing the market really rallying off of that, saying, well, growth is better for markets. So the Fed has said they're going to cut no matter what. So who cares what the CPI print says? If they're going to cut and growth's going to be here, that's going to be good for us. So it's interesting to continue to see what the broader market is doing this morning. I'm just taking a look at what we've got across the board. Still seeing a little bit of red. The S&P is a little bit flat, though. So it's interesting to see kind of what those moves are looking like. But as I mentioned, that hotter than expected CPI data coupled with economic forecasters boosting their predictions for economic growth, that's proving to be a welcome sign for this rally. So here to explain, we've got Yahoo Finance's Josh Schaefer. Josh, what's going on with this bifurcation between markets and data?
Yeah, so we added those two things together, Maddie, and essentially got no change in what the expectations were for the Fed, right? And that was sort of one of the broader takeaways we had from sort of digesting both yesterday's report, but then also going back to last week's jobs report and other economic data we've gotten in the first 2 months to start this year. And really one of the things that was surprising to me as I was sort of going through these different notes was how many economic forecasters are actually boosting their projections for the first quarter and the second quarter for GDP, specifically looking quarter over quarter. A pretty big jump we found from the consensus forecast on Bloomberg that we saw in January versus what we ended up seeing now. It went up from about 0.6% to about 1.8% now. So pretty big increase in what the expectations were for first quarter growth. And guys, really the important part of that, of course, is economic growth is considered a good backdrop for stocks overall. And it's something that helps when we think about the inflation story. If inflation is going to be a little bit stickier here and the Fed's going to have to hold higher for longer, many of these economists feel that the economy can be okay because we're still growing. So overall, maybe we will be able to still fight off, I guess, those higher rates in some ways and not dip into a recession.
So Josh, what does that then tell us about potential leadership here? Mentioned the fact that we're starting to see market breadth expand just a bit. Is that a trend that is expected to hold, given if that is in fact the case, that the economy is able to hold up and weather some of the volatility that we have been seeing? So
I spent Monday writing part of this story and writing about market breadth, and then yesterday we had NVIDIA up 7%. We had NVIDIA up 7% in a full-on tech rally again. So take it all with a grain of salt. But overall, one thing that Lori Calvasina over at RBC Capital Markets have been highlighting in her Sunday weekly note was we're starting to see signs of breadth, right? So we highlighted last week that the S&P 500 equal weight that is not driven by a couple of large tech stocks, again, equally distributed amongst the 500 companies, just hit its first 52-week high. You take a look at the Russell 2000, that had been outperforming the S&P 500 over the past month, again, up until yesterday. But overall, we're starting to see some signs of market breadth because the take from many strategists on the street would be if the economy is doing well, that's a good backdrop for the broadening out of the rally. And right now, when you take a look at earnings, it seems like there was some level of earnings breadth that we saw that was increasing. So they think that that is going to lead to a broadening out of the rally. Shauna, of course, the risk there being, well, what if the economy falls off because we do stay higher for longer? And at some point we still have three rate cuts priced in. What if that comes off the table?
Yeah.
What if we're talking about no cuts? Then are we really still going to be talking about a broadening out? Your guess is as good as mine.
And then there has been more conversation that, hey, when you take a look at the fact that the market is still banking on those 3 cuts, the fact that there is so much optimism about that first rate cut coming in June, whether or not that's valid or really is supported at this point is something that is up for debate from many strategists out there.
Absolutely. And it seems like I keep coming back to yesterday because the most interesting thing to me was just when we got a little bit concerned about an inflation report, right? And we were a little bit wondering sort of, how do we read this? Where do things go? People just piled back into 4 stocks where we're confident in the earnings growth. Like we just went pure flight to quality, pure, let's just go to these names that we know, and there really wasn't signs of strength when it comes to that. So I don't know, it'll be interesting to see as we get maybe next week a dot plot that, does it have 3 cuts in it? If the dot plot doesn't have 3 cuts in it, what does the market do? I don't know if the market's going to love that.
Well, yeah, the market sees what it wants to see. It's made that very clear. Right?
Always does.
Yeah.
I know, and NYSE yesterday, all the guys were like, as long as inflation stays good for the market, then we're going to love it. As long as it doesn't start to tip into a negative territory, if it means consumers can still spend, companies can raise prices, then it's good news. So we'll have to continue to see, but a lot of bifurcation to look at. Thank you, Josh. Really appreciate it, as always. Coming up, we're going to talk about gold because another weird thing going on. Gold's record rally continues, but is it premature? We're going to break that down on the other side of this break.
Big tech giving back some of yesterday's gains. You're looking at a drop of just about 0.5% here for the Nasdaq 100 at the open. The moves this morning coming off a record-setting day for the market. The S&P 500 still hovering not too far from yesterday's record level, just trading just below the flat line here in early trading. We want to bring in Ed Clissold. He is Ned Davis, the Research Group's chief U.S. strategist. Ed, it's great to have you here. So we saw another move to the upside yesterday with the S&P closing at another all-time high. Some give back in early trading action today, but take a step back. How does this set us up here to the action that we will likely see play out in the coming weeks?
Yeah, it's an ongoing bull market. You think about the concern right now is the economy too strong for the Fed to cut rates? That's actually a pretty good place to be. And we think the Fed will cut maybe a couple of times this year. But in fact, the market has done better when the Fed has cut slowly, up about 24% in the next year. That's not a forecast. That's just the average historically, versus up only 5% when the Fed has cut quickly 5 or more times in a year. So this is actually a pretty good place to be. Now, short term, we've come a long way. There's lots of optimism. If there's a breather, a pullback, that may actually be a healthy thing for the long term. But big picture, things are in pretty good shape.
So, Ed, what's the catalyst here? Why did we see so much green after that hotter than expected inflation print, and then we're seeing this pullback today? What is the reason?
Well, I think that the initial reaction was, this is a repeat of last month, where it was a hotter expected inflation number. But the market really prices in the same news the same way. We've already gone through that discounting of moving out. A month ago, the market was looking for 5, 6, maybe even 7 rate cuts coming up, and now the market's pricing in 3. Maybe that's a little bit too much, but the market's moved to where the Fed has told it wanted to be the whole time, and so given the fact we've come a long way, there's lots of optimism in the market right here. Take a breather wouldn't be too surprising.
How would you then position at this point, if we're going to see a bit of a breather here in the markets, what adjustments should investors then be making to their portfolio because of that?
Sure. If you're a short-term trader, you maybe consider, if you don't have a lot of exposure to what we call the shut sectors, that's staples, healthcare, utilities, and telecom. At this point in the cycle, particularly during election years, during the second quarter, they tend to outperform. Again, that's a shorter-term perspective. Longer term, still stay cyclical. But that's a way to maybe get into some areas that have underperformed over the past several months, and even going all the way back to the bull market that started in 2022. It's been historically weak for those areas. So if there is going to be a little bit of rotation defensively, if the market takes a breather, those are the areas we would focus on.
Ed, you mentioned the election year, and I'm curious about your take on how the election year could interplay with the Fed's moves. We have Stephen Stanley with a call for 50 bips of cuts this year after the election, so meaning after November there. To what extent does the Fed sort of have to wait until they know who the president is and how that will impact fiscal policy to be able to move forward on monetary policy?
Well, I think in terms of before the election, if anything, it would actually give the Fed a reason to go ahead and do one cut maybe in June versus waiting a little bit longer. Because once you get into the throes of the general election, the Fed, above all, does not want to be viewed as being political, even though historically, occasionally they have been. They don't want to be viewed that way. So maybe that they would actually get started. And then afterwards, the Fed has been pretty clear that they are not trying to direct fiscal policy, but they are going to have to react to it. And that's part of the reason I think they were so aggressive in hiking last year. We had this accidental fiscal stimulus with a massive $140 billion increase in Social Security spending just from cost of living adjustments last year. So those sort of things will impact the Fed after the election. But before it may actually mean the Fed goes ahead and starts the easing cycle so they don't appear to be favoring one candidate over the other.
I love that we're still talking about easing as if we didn't get this extremely hot CPI print yesterday, Ed. Thank you so much. Really appreciate you joining us there, Ed Clissold from Ned Davis Research Group, Chief U.S. Strategist there joining us. We're going to talk about gold now because gold's record rally isn't showing signs of slowing down, having its best month since October as investors gain more optimism around rate cuts to come this year. But our next guest says the rise could be premature. Stefano Pasquale, Barclays equity derivatives strategist, is joining us now. And Stefano, thank you so much for being here. I can't get over the performance that we're seeing of gold layered next to Bitcoin because it just looks like they are exactly layered on top of each other. And one of them seems like a risk on vibe and the other seems risk off. Help me understand how this market is having both of those dynamics play out at the same time.
Yeah, sure. Thanks for having me in the show. So obviously gold recorded really a rally for the books. So the 7% rally that we've seen over the past month has been higher only 6% of the time over the past 10 years, right? But it's not only the extent of the rally really that's been impressive. It's also been essentially the persistence and the strength. So just if you consider that gold has been recording 9 consecutive daily positive returns, that's only happened a bunch of times in the past 50 years. Like that's one of the highest up streaks for gold. And so the intensity kind of suggests that there's something else other than fundamental drivers sort of at work here. And we do think that it's sort of also linked to technicals. So, for example, if you look at the bonds rally and the sell-off in USD, I mean, famously, the US dollar and yields are 2 mechanical drivers for the yellow metal. There were obviously some important tailwinds behind the rally in gold, but they do not explain the full story, right? So, for example, our model shows the yields and the US dollar should have accounted for only 1/3 of the actual rally that happened. So there's something else at work. Now, we did some positioning analysis, and basically there's a strong evidence that the Fed pivot sort of forced macro funds to switch from having a negative exposure to gold to a positive exposure. In other words, sort of the prospects of the first cut forced a lot of macro funds out there to cover their short positions, right? Now, in a way, we think that the macro environment is supportive for gold. I mean, we do think that there's going to be a first cut in June. And if you look historically, gold has done pretty well around the start of a cutting cycle. However, we do caution a little bit here because we think that gold is running a little bit ahead of itself. Yeah. So that's a very interesting stat that shows, since 1980, gold tends to be muted ahead of the first cut. In fact, it only rallies after the first cut has been already delivered.
Yeah, so then
that's not the case right now.
Yeah, Stefano, then how much is that already fully priced in? And then that also begs the question, if we don't get that rate cut when the market is expecting, are we actually going to see some downward pressure then on gold in the near term?
Yeah, I think that's fair. So obviously part of the rally has already happened, which is why we're calling for caution. So, typically the rally that happens after the start of the cutting cycle is about 10%. And so we're almost already there, right? There may be some more upside room left, but, obviously compared to history, a lot of the rally has already happened. So one thing you can do actually, instead of waiting for a better entry point, which is, famously very hard to time the market, one alternative is to actually use options, right? So, for example, the strategy that we are recommending is to gain upside exposure via call spreads. I mean, that strategy, obviously, the advantage is that for a price, it has some sort of insurance built in. So you have upside exposure, but you're not exposed to the downside. And right now, I think volatility markets are really giving you a really good entry point for that type of strategy.
Stefano, we have less than a minute left here. I'm just curious, who is the buyer for gold right now? What is that profile looking like?
If you look at the market through different segments of investors, it does look like retail investors have been absent from the recent rally. So we actually seen a lot of outflows from gold ETFs. On the other hand, macro funds they switched from being short to now being long. And obviously, the other big players are central banks, which have been big buyers now for many months in a row.
All right, Stefano Pasquale, really appreciate you joining us, Barclays Equity Derivatives Strategist. Thank you so much. Now, coming up, Tesla shares are trading down this morning. We're going to have more on the company's latest performance on the other side of this break. Tesla shares edging lower this morning, down about 2% here after Wells Fargo downgrading the stock to underweight from equal weight, also slashing its price target on the EV maker. The firm seeing some major headwinds for Tesla, noting disappointing deliveries and price cuts will likely drive negative EPS revisions here. And this comes after Tesla is already down a whopping 28% year to date. And we know from other guests that we've had on that this is, a good play if you're looking at it like a car maker, right? We've had Dan Ives say multiple times that folks in the U.S., at least the consumer, if they're looking for an EV, they're probably thinking that's synonymous with a Tesla. So that's a good thing for this name. But if you're looking at it like a tech company and part of the Mag 7, it's just not looking like it's part of that broader basket at this point.
It certainly is not, Maddie. I mean, take a look at these numbers. More than $220 billion has been wiped off its market cap since the start of the year. It's among the worst performers in the S&P. The stock falling 29% through yesterday's close, so making it one of the worst performers within the S&P since the start of the year. When you take a look at this note and the call out from Wells Fargo, he doesn't expect, Colin Langan there, the analyst, doesn't expect the picture to really improve anytime soon for Tesla. He actually calls it a growth company with no growth. He's pointing to their sales, the trends that they've seen play out over the last couple of quarters, saying that in the second half of 2023, from the first half, they only saw 3% in sales volumes, 3% growth in sales volumes. Prices were down 5%. And then when you look out to what he's expecting for this year and for next year, he expects sale volumes to be flat this year and then to actually fall in 2025. So we talk about the fact that the EV market clearly not seeing the demand that many had anticipated. You also have the price war that has played out, pressuring margins at many of these companies. Yes, Tesla does have an advantage when it comes to margins versus the traditional automakers, but they're not immune to obviously the larger factors at play within the sector, and the fact that the demand is not there, at least from Wells Fargo's perspective. It's going to cap the movement here that we could see to the upside in the coming quarters.
Well, it's such a great point, Shauna, and they talk about how Ford did say that they were reassessing the electric vehicle plans. We also heard from Apple saying that they were winding down their electric car project after 10 years of investment, putting that money instead into generative AI, going along with that rally that we're seeing there. And it does look like, as of this morning, if we look at the boards that we just had up, Ford is up, while Tesla obviously continuing to struggle here. We're also seeing General Motors up, General Motors scrapping the development of their sub 30,000 EVs. So interesting to see that the names that are slugging off their EV plays maybe getting a little bit of upward motion here. Again, this Wells Fargo price target implies a 75% downside for Tesla. That is crazy.
It is crazy, especially because so many people have been hyping up the name, obviously, over the last several months. Very excited about the momentum that we saw play out. A lot of this, though, driven by valuation. And he points out that even with the decline that we've seen in the stock, that in shares, the stock still trades at 55 times its forward earnings compared to an average of about 31 for the Mag 7. So it really puts that valuation question in perspective. But again, Wells Fargo seeing more downside ahead for Tesla. All right, keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Welcome back to Yahoo Finance Live. I'm Madison Mills alongside Shauna Smith. We are about 30 minutes into today's trading day. Stocks taking a bit of a breather this morning after yesterday's big rally, but we want to turn our attention over to Washington, D.C. A vote in the House of Representatives just getting underway on a bill that could lead to a nationwide ban on TikTok. Here's what Congressman Raja Krishnamurthy, the Democratic sponsor of the bill, had to say on intentions behind the proposed legislation. Take a listen.
This particular bill ensures that ByteDance divests itself of the vast majority of the ownership of TikTok. Our intention is for TikTok to continue to operate, but not under the control of the Chinese Communist Party.
That vote under fast-track rules requiring support by 2/3 of the House for the measure to pass. So for more on the vote, what it means for the social media landscape more broadly, we're going to turn to Angelo Zeno, CFRA Research Senior Equity Analyst. We also have with us Kim Wallace, 22V Research Senior Managing Director and Head of Washington Policy Research. Thank you both so much for joining this morning. Angelo, I want to start with you because obviously this has huge implications for any investors behind the company. What do they need to know heading into this vote today?
Yeah, no, as far as kind of, this specific event, I think what you need to know is it's probably not going to get resolved, in the immediate near term. So, you're going to essentially kind of have this vote take place. It'll be interesting to kind of see what the outcome looks like here. But if you do get strong support, obviously, then, it goes to the Senate, and we'll see what, if the Senate decides to kind of put this to the floor. But, listen, at the end of the day here, it does have support from the White House. But we also need to also understand that, if this eventually kind of fully goes through, there's also kind of legal aspects to it. So what I would tell investors out there is don't expect to necessarily get an outcome in a way to kind of play this necessarily overnight. But as we kind of, see this thing kind of play itself out here over the next couple of months, quarters, and as we kind of go into 2025, if we were to see some sort of ban out there, that would have huge implications to a number of players, on the U.S. side of things.
Kim, how are you looking at the odds that this is going to not only pass the House, but the Senate? And then we talk about the potential fallout if, in fact, it does pass, looking ahead to the current election. Put that in perspective for us.
Well, I think Angelo's done a good job. There are going to be periods of volatility for likely a protracted time as the legislation moves from the House to the Senate. I continue to believe that the vote counters in the House have this more right than wrong. They think they have over 300 votes. If that's right, that's above the what I call psychological threshold of 291, which is the number of members in the House it takes to override a veto. So the president is on good ground if you get more than 291 from the House. Angelo's right. As this moves to the Senate, we've already heard from the Senate Majority Leader, this is not on a fast track. We've heard from some leading Democrats who chair committees, Commerce and Intelligence, that they have reservations about some of the drafting of the bill. All points to a negotiation. Whether or not that's protracted and what protracted means, whether it's weeks, months, or longer, we're at the beginning of finding out.
Kim, I want to stay with you because I want to look a year ahead from now. I'm curious about how current President Biden's reaction to this potential ban, as well as former President Trump's reaction to it and how they've handled it thus far. What does that tell us about how they might handle business dealings like this if either of them ends up sitting in the White House a year from today?
It's a perfect comparison of the contrasts between the two men. The legislation in the House wasn't struck over last weekend. Much of that drafting was done by the interagency task force that looked at this issue from the fourth quarter of 21 through the middle of 23. And so all of the language in 7520 and 7521 has been debated in committee and certainly vetted within the administration. Former President Trump, on the other hand, has pivoted on his support for similar legislation, which is not unusual. We saw this from him in the ZTE Huawei circumstances, in the second half of his term. At first, he came out very strongly trying to isolate those companies and their products from the U.S. market. He heard from friends who happened to be investors, and he backed away from that position. We're seeing the same thing. One man, the former president, is extraordinarily transactional in his personal contacts. The other man, Joe Biden, is extraordinarily collegial, if you will, consensus building, given his history on Capitol Hill through his personal contacts.
Angelo, flipping back to the investor perspective here, what's your read just on what this means for the other competitors within the space? If you take a look at Meta, you take a look at a name like Snap, who is positioned then to benefit the most, at least in the near term?
Yeah, I mean, what we've told investors out there is if you were going to kind of play this event, the best way to play it actually is with Snap. And, big reason for that is, one, when you kind of look at where engagement levels are, who kind of TikTok caters to, it's very similar to the kind of, individuals that Snap kind of caters to out there. So you would think in terms of digital ad spend dollars, you can kind of see some sort of shift, from TikTok to Snap if we were to kind of see some sort of outright ban out there. What we would also kind of say is also when you look at the revenue levels of Snap relative to some of its bigger peers out there, and you look at the revenue levels of TikTok, they would only need to get a sliver of that kind of ad revenue dollars out there to have a notable driver to the revenue trajectory of Snap here over the next couple of years. Whereas a company like Meta, where they would likely see improving engagement levels from a TikTok ban, unlikely going to see a huge kind of swing in terms of the revenue trajectory, at least initially, in terms of a potential ban there.
Yeah, Angela, Roth MKM this morning adding streaming platforms like Netflix and Disney Plus as potential beneficiaries to this as well, getting more of that screen time. But Kim, I want to flip it back to you because regardless of whether or not this bill passes, if the Chinese government does oppose the sale, that cuts off a clear liquidity path forward for investors. So given that, and given the fact that China today is saying that this proposed ban would come back to bite the U.S., what does that tell us about the impact of U.S.-China relations on policy like this and other policy moving forward?
Not really much in real term. What we do know and what this underscores is that the competition between the U.S. and China is increasing. It is serious. It's multi-platform. And in the Biden administration, it's been strategic. They like to use whole of government phrase. This is a pivot, a significant pivot from the period 1999 through 2010, if you will, when most U.S. policymakers were still enamored with the notion of inducing China into the global economy on non-market economy terms that were granted in WTO accession. Since that time, clearly there's been a backlash to some of the practices China deploys through its technology in particular, certainly around surveillance, not just through TikTok app, but other technologies globally.
All right, Kim Wallace, Angelo Zeno, thanks so much for hopping on here and breaking down the story. We're going to continue to track the votes as they come in this morning. Kim and Angelo, thanks. Coming up, we speak to a strategist on the biggest threats to the market and the economy. The call coming after the S&P closed at another all-time high. We're seeing it drift a bit lower here in early action. You've got the S&P just below the flat line. Nasdaq off about 0.6%. We'll be right back.
Stocks are taking a bit of a breather this morning after that big rally Tuesday. The major indices eking out gains over the past 5 trading days, despite that hotter than expected inflation print. Most Wall Street forecasters believing that a soft landing is near, but not all of them do. To break down some possible risks for the market, we have Gary Shilling here. Gary Shilling, and co-founder and president of Gary Shilling. And Gary, thank you so much for joining us here. I know that you are pricing in a big potential risk when it comes to commercial real estate, and you predicted the housing market collapse in 2008. What similarities are you seeing between these two factors here?
Well, the commercial real estate is not nearly as big as the subprime mortgage market was back then. It is really falling apart. There's a lot of pain, but it's much more restricted. You look back then, and huge number of people in the country were involved in subprime mortgages and really suffered as a result. The commercial real estate, I mean, you've got the severe problem with office buildings that are half empty and people who don't want to go back to work in their offices and so on. And those affected are in trouble. But as I say, it doesn't mean there is any less pain intensity, but it means it's not nearly as widespread.
So, Gary, when you're talking about the potential fallout of that, I guess more specifically, how big of an impact do you see that having on the broader market?
I don't think it's not enough to sink the ship. I mean, if you look at the subprime mortgage fiasco in 2008, it gave us the most serious recession since the 1930s and all its ramifications. I think now the economy is vulnerable. This is certainly a negative. You've got a lot of other things indicating that, inverted yield curve, leading indicators being weak, et cetera, the Fed's interest rate increases and so on. But again, it's just not the same order of magnitude. Yeah, this could contribute to economic weakness, but it isn't going to give us a global collapse, at least as far as we can see right now.
So, Gary, what does it do then? Because we've been talking about the commercial real estate risk for so long. It just feels like this zombie in the back of the room that you kind of ignore at this point. How concerned do we need to be? I mean, if you had to put a number on it, how big of a downside risk could this have on financial markets?
Well, I don't know. You said for a long time. I'm not sure how long a long time is. But the last couple of years, this has been clear ever since the pandemic, when people were staying home and office buildings occupancy went down to about 50%. Obviously, it's been a couple of years, but this could potentially knock a percentage point or so off of real GDP. But again, it isn't like the 5 or 6% declines that we saw back with the subprime mortgage collapse. And as you may know, I've made a career out of looking for the hidden flaws, and I've found a few, but this is not one that's big enough to really take the whole economy and financial markets down, in my judgment.
Gary, when you take a look at the residential side of things today, we were just talking to the CEO at Redfin yesterday, and he was telling us that we are starting to see an uptick in inventory, that things are looking a bit better from his perspective. What is your outlook, or how are you looking at the current trends that we're seeing play out in housing? And do you think we're going to get a little bit more activity?
It's a really unusual situation in that what happened, of course, is a lot of people got very low-cost mortgages back before the Fed started raising interest rates, before the pandemic. So they don't want to move, because if they were moved, go to a different house, they get a new mortgage at a much higher rate. So that's really created a lot of desire just to stay put. And it's created a artificial tightness in labor in housing markets, which it won't continue indefinitely, but it certainly is disruptive right now. And what it means is that there is a tightness in the market, that the lack of inventories of used houses for sale and so on and so forth. But again, housing is a very interesting area. People act like there's a huge inventory of people out there just waiting to move into houses. Well, houses are, just by definition, households are formed when people move into a separate dwelling unit. That's the official definition. So you have to have all the forces and indications that want to make people do that. and that includes their financial ability. And right now, if you look at it, 40% or more people simply can't afford housing by any traditional standards, given the high prices and their income levels and so on and so forth. So, to sort of act like this is an evil being imposed on the American people, the economics are there. If people can't afford it, they can't afford it.
But Gary, you bring up a great point, which is that 40% of people aren't in a position to buy a home, which begs the question of whether or not the Federal Reserve's rate hiking cycle is having an impact on the American consumer if they've given up on the idea of being able to buy a house anyway, which is impacted by, of course, the real interest rate there. So I'm curious then, as an economist yourself, what do you make of the actual real impact of the Federal Reserve's really aggressive rate hike cycle?
Well, the Fed raised rates to slow the economy. I mean, they didn't do this just because they didn't have anything else to do. I mean, the whole idea and housing is perhaps the most vulnerable aspect of the economy to interest rates because it's so highly leveraged. I mean, you look at an FHA loan, 3% down. That's a 33 1/3 times leverage. So it really doesn't take much in the change in the price of the loan or interest rates to make a huge difference in people's ability to afford houses. So it's a very it's probably the most sensitive area to the Fed action. So it's no great surprise that we've seen this. And as I say, on top of that, you had all these people who had the earlier low rate mortgages before the pandemic. So it's kind of a perfect storm kind of situation.
And Gary, going off that, the conversation, the debate that's really been dominating Wall Street now for several months has been Fed policy and the timing here that we could see of that first rate cut. I'm curious what you think is ahead, or what you think the CPI print that we got yesterday, how that is going to factor in to the Fed's timing of rate cuts, and what you think is the likely activity here between now and year end.
Well, everybody gets all excited about when the Fed is going to cut rates. And, if you go back a month or so, it was 6 times this year. Now it's down to 3 times, which is basically what the Fed has been saying. But bear in mind that the Fed doesn't cut rates in a vacuum. They cut rates because they see the economy weak enough that they can stand lower rates without rekindling inflation. That's what there is. It's not as though they just are up there saying, "Oh, well, we're Zeus on high, and we're going to cut rates because we think that'd be a good thing to do." So you have to look at what are the circumstances here, and bear in mind that the Fed was really behind the curve earlier. You look back before Powell came in as chairman, you had this series of 3 predecessors who were really in the put business, the Greenspan put, the Bernanke put, the Yellen put, meaning Wall Street assumed that any problems could be unloaded on the Fed. So they had that. He was behind the 8 ball. And then also early in 2022, the Fed was slow to recognize the burst of inflation. As a matter of fact, they only started raising interest rates in March of 2022. And that was only 3 months before the CPI peaked at 9.1% increase year over year. So the Fed was really behind the curve. And that meant that to reestablish credibility, which is very important to the Fed, because if they lose credibility, then they've got a serious problem. But it meant that they had to be extra vigilant. So I think that that's one of the reasons that the Fed is going to be, and I've been saying this for the last year or more, the Fed is going to be very slow to cut interest rates. The other reason is that the labor markets have not responded to the Fed in terms of weakness. A lot of that was because employers had so much trouble hiring people earlier during the labor shortage period that they're very reluctant to lay them off.
Right.
And that's really the ultimate key is employment. If you have labor markets as strong as they have been, this does not induce the Fed to reduce rates. It produces income. Okay, people spend the money. That's all and good. But it doesn't mean that the economy is showing the kind of restraint that the Fed wants to see. So I think all these things suggest to me that we're going to see the Fed continue to be basically tight throughout this year.
Higher for longer, and that's why some folks on the street are now saying we may have no cuts this year, Gary. So it's definitely interesting to watch. We'll have to have you come back and give us your reaction as we get more news from the Fed to come. Gary, thank you so much. That is Gary Shilling, Gary Shilling, and co-founder and president there joining us. Now, we're also going to talk about dividends because global corporate dividends hit a new high of $1.66 trillion last year, with banks making up half of that. Worldwide, 86% of listed companies either increased or maintained their dividends. That's all according to a quarterly report done by the Janus Henderson Global Dividend Index. And it's just really interesting seeing this new record of $1.72 trillion in dividend payouts this year. This was such a big deal that it contributed to the jobs report. We saw that personal income, at least 4 percentage points of that was attributed to the rise in dividends. So it paints to this broader picture of how we're continuing to see a correlation between market performance and the strength that we're seeing in consumer spending in the overall economy.
Yeah, exactly. The strong, healthy corporate balance sheets are really here at front and center, and that's a big driver of the dividend action that we have seen. You mentioned, Maddie, what we were seeing globally, even here within the U.S., very impressive number. $602.1 billion in total was handed back to shareholders last year through dividends. That was up 5%. Microsoft in the top spot here, the largest dividend payer last year, handing out more than $20 billion in cash to shareholders, followed closely by Apple. Apple was in the number 2 spot, but you're talking about what lies ahead here for 2024. And like you were saying, $1.72 trillion on a global basis is expected to be paid out, another 5% jump. So that also it is very similar to some of the calls that we have gotten from others on the street. S&P Global was also out predicting another record level of dividend growth in 2024 when they're looking for another 4% increase globally, 6% here within the U.S. So this is a trend that has been talked about over the last several quarters, was certainly something that we called out in this most recent quarter as a trend that we've heard many of these companies that not only are paying dividends, but also raising the amount that they are paying to shareholders. So it looks like, at least if these forecasts are right, we could be set up for another record year ahead.
Yeah, I remember being on with you a couple months ago and you booking a guest who talked about the importance of getting in on dividend plays because at least it's a guarantee of cash, and that's kind of a hedge against any of the macro concerns. It's also interesting looking at some of those big tech names that you mentioned. I'm fascinated that Meta isn't even in the top couple there, because just Mark Zuckerberg alone is expected to make $700 million in dividends due to that dividend increase from Meta this year. So not a bad year of returns there.
Yeah, exactly. That surprise announcement that we got at Meta in its latest earnings report. All right, we'll keep right here on Yahoo Finance. Much more of the market action ahead. Oil prices are moving to the upside today. You're looking at crude trading just below $80 a barrel. We are going to take a closer look when we come back.
Crude oil prices are climbing higher this morning as we see Ukraine damage Russian oil refineries in a second day of heavy drone attacks. This coming amid reports of falling U.S. crude stockpiles. Meanwhile, OPEC maintaining its 2024 oil demand forecast, expecting it to grow by 2.2 million barrels a day this year. How are all of these factors going to come together to impact oil prices moving forward? Joining us to discuss in studio, we've got Scott Bauer, Prosper Trading Academy CEO. Scott, thank you so much for being here in studio with us.
Great being here.
We
Thank you.
appreciate it. There's no shortage of news that I could have started this interview with this morning, but I'm just going to go with Ukraine because I'm curious whether that is indicative of a trend to come. If we keep seeing these moves from Ukraine to hit these Russian oil refineries, what is the impact that has on the price of oil?
Yeah, and I really believe that over the last probably year or so, we've had at least a $5 premium in the price of crude just due to geopolitical risk, most of it coming from Russia, Ukraine, and then obviously Middle East as well. But this has, heightened things a little bit. And then you got some rhetoric from Putin today talking about the nuclear arsenal sort of thing. So I think you have that tailwind for crude, which can happen at any time. I mean, we can see an escalation at any time. And we've seen this consolidation in crude over the last, 3 months, 4 months or so. We've seen 75, maybe 73 on the low side. We're pushing up on that upper end again right now. And I really think this could be the opportunity that crude is going to break through that $80 number, which is really just a psychological number, but it's a big one because that has been the upper band here. So the geopolitical risk, that is absolutely a major, major tailwind for the price of crude.
If we do see a break above that $80 a barrel level there, what does that then mean to the upside that we could see further in price?
I think you're going to see a lot of shorts capitulating and giving in and driving the price up pretty quickly. So I would target 84-ish area without any further escalation in the geopolitical realm. Again, you've got the $5 in my estimation, but you've also, you have to look at what's going on with the economy here, what's going on with the US dollar. And quite frankly, recently, the dollar has come off those highs. It's been weakening. We saw it strengthen a little bit yesterday, but overall, that trend is to the downside as well, which that gives another tailwind to the price of crude.
And when we think about what's going on here stateside, obviously we've got that big election coming up.
Really?
Rearing in the background just a little bit there. How big of an impact does that have on the price of oil this year?
I mean, it's definitely going to be a bone of contention on both sides. There will be some political fodder on both sides. I would like to think that that's not really going to play into the price of crude. And I think that, supply and demand, that really is going to set the prices. And the one thing we haven't touched on yet is China. Yeah. For the longest time, right, we've seen demand destruction really coming out of China because their economy is just not recovering. If that starts to turn around at all, which I think it may, and I've been very bearish on China for a long time, and I see it maybe turning around a little bit, that also is going to be a tailwind for crude here. So over the next 6 months leading into the election, we have so many hot points that can really change the price of crude in a heartbeat. I would watch that break of 80 up to 84 or so, and I think that we see a bottom, a near-term bottom for a while here, probably right around 75 or so, which a lot of people aren't going to be happy with that.
Yeah, and Scott, drilling down into one of those factors that you just said, specifically China, the recovery there, it's hard to gauge when you were talking about timelines here, but I guess, is that something that you see playing out within the next couple of months, or how quickly could we see that really impact prices?
I think we could see that over the summer, and certainly leading up into the election. That could be a hot point as well, that if their economy does start to recover and geopolitics don't calm down, we could be headed for higher prices going into the election, which, one side's not going to like that.
What's the catalyst that you're thinking of that's going to lead to that growth in China?
I just think that they have been stagnant for so long that
they have to go up.
Yeah, you've got the international community, international buyers really just almost at a point now saying, where else can it go? Yeah. So I'm looking at that, and I've seen that stagnation. And just like we were talking about oil, when oil consolidates or any commodity consolidates for a long time, there's usually a big move, a big volatile move coming out one way or the other. I see that potentially happening in China to the upside.
Scott, switching gears here real quick. Got to get your thoughts on the movement that we've seen to the upside in gold. We had gold at record highs. We've seen it give back just a bit today. What do you think that tells us about how it sets us up for the pricing action here heading into that first rate cut?
Well, I think that tells us that the community, if you will, the sentiment is we need some safe haven assets. And I'm not going to compare it to Bitcoin because I think that's a whole separate conversation here. I do think that with the dollar again, where it is right now, there's a lot of money pouring into gold. 2150, which is not so far below where we are right now, just off of the highs. I think that's a real good point where you're going to see a lot of money starting to come back in. And I think we're going to break those all-time highs that we just saw sooner rather than later.
All right, Scott Bauer, great to have you. And great to have you on set here today, CEO of Prosper Trading Academy. Thanks, Scott. We'll keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
The price of Bitcoin has no shortage of catalysts, from the debate around regulation to whether it's a security or a commodity, and whether or not it really is digital gold. But one event is undeniable in its impact on the world's most premier digital asset, the halving. Every 4 years, the reward for mining the biggest cryptocurrency is cut in half. This happens in order to reduce the amount of coins in circulation. How is it calculated? Well, it happens specifically every time 210,000 blocks are mined. We can calculate the date fairly precisely with the knowledge that the average block time for Bitcoin mining is around 10 minutes. That calculation gets us very close to 4 years. Why is it needed? Because there's only so much Bitcoin available, 21 million to be exact. And like any other cryptocurrency, it needs to remain scarce to hold its value. So how often does this happen? Well, the halving takes place every 4 years. The first in 2012 decreased the award for creating a new block from 50 to 25 Bitcoin. The second halving in 2016, that lowered the reward further from 25 Bitcoin to 12.5 Bitcoin. Last time out, 2020. And you guessed it, we halved again. The block award dropping to 6.25 Bitcoin. So there's nothing wrong with your math here. This time around, the block reward miners will receive half, 3.125 Bitcoin. The big question, of course, what happens to the price? Now, the moves could be significant. In the past, we've seen Bitcoin rise after a halving event, though there's no certainty that this will always be the outcome. The other key focus is the outcome for the miners. The rewards that they're generating will, of course, diminish, and that's not great for an industry with a very high cost burden. Keep an eye on how the big publicly listed miners, the likes of Marathon and Riot, manage this event. As ever, talks of consolidation will no doubt do the rounds. No matter how you look at it, the event will have serious consequences for all crypto stakeholders and will be across all of the developments here at Yahoo Finance.
Bitcoin is the highest form of property. It's the apex property in the world, and it's the best investment asset. So the end game is to acquire more Bitcoin. Whoever gets the most Bitcoin wins.
Whoever gets the most Bitcoin wins. MicroStrategy chairman Michael Saylor, a longtime Bitcoin bull, raving about Bitcoin as an investment, the digital asset reaching new highs this week, coming off the launch of spot Bitcoin ETFs. Crypto-related stocks such as Coinbase also doing very, very well, up roughly 50% since the start of the year. Next guest saying that there's still a compelling upside case to the crypto exchange. We want to bring in Devin Ryan, Citizens JMP Director of Financial Technology Research, joining us now. Devin, it's great to have you here at the desk with us. So just first, your reaction that we've seen to the massive increase in the price of Bitcoin, and obviously Coinbase, a big beneficiary of that.
Yeah, absolutely. First off, great to be here. What we talked about, we actually put a report out last night. There's been $10 billion of net inflows into these ETFs over the last 2 months. We are saying that we think there will be $220 billion of additional net inflows into these ETFs over the next 3 years. So the comment is that the ETFs are truly transformational for this space. What we're talking about with the ETFs is there's $25 trillion of financial advisor-driven money that really hasn't been allocated yet, and the ETFs open the door to that part of the market. And so, of course, yes, when there's big demand, the $10 billion is driving prices higher, and then ultimately that's really good for companies like Coinbase because they're benefiting both from the ETFs directly in trading those, but there's a lot of interest just in crypto more broadly, so their trading volumes are up over 100% in the first quarter over the fourth quarter. And then, bigger picture, Coinbase to us is really a play on just the evolution of the asset class. And so that's really, I think, what people have missed so far in the stock, and that's why we think there's still quite a bit of upside, because they're going to evolve their business model with the evolution of the asset class.
In terms of flows, when we look at Grayscale's Bitcoin ETF, definitely struggling a little bit. I see the smile there. Over $7.5 billion of exodus there in the first 30 trading days. Is that an idiosyncratic issue for them, or is that indicative of maybe some outflows to come for other names?
Yeah, I think they're really specific. So there's at least a couple $2 billion of that you just cited that's related just to some of these bankruptcy estate sellings, and I think that's already generally played out. And then there's also some selling from people that initially got in to Grayscale because they were just playing the trade around the premium that the GBTC was trading to Bitcoin several years ago, and then ultimately, even more recently, the discount. And I think there was some traders in that, and so some of those folks have exited. And then you're seeing a little bit of rotation too, where some people have been selling that ETF and going to some of the lower fee ETFs. So they actually just announced yesterday another ETF structure. So I think they're going to be back in the game, potentially bringing in inflows. But yeah, I think of that as really idiosyncratic. And then the net flow story is really what we're focused on, which is $10 billion over 2 months.
You mentioned the fact that you see Coinbase's business evolving, the platform evolving as the industry does. How so, and what does Coinbase need to do in order to maintain that edge?
Yeah, I mean, I think that's really the key story. We've been framing Coinbase as, it's a little bit cliche, but the Amazon of crypto. And what I mean by that is, they got into buying and selling, as an exchange, really as that was the first foray into crypto. That's becoming increasingly commoditized. Now, there's still going to be huge growth in the exchange platform, but Coinbase is really the primary on-ramp, or one of the primary on-ramps into the asset class. So if folks want to get involved in payments or remittance, or in our opinion, tokenization of real-world assets, Web3, they have their own blockchain called Base. They're going to be involved in virtually every aspect of how this industry grows. And then there's going to be parts of this industry, in our opinion, that are really idiosyncratic to crypto. So, staking is an example, and there'll probably be other innovations. So Coinbase is going to be involved in all of that, as they already are. Their subscription and service revenues were essentially zero in 2020. Now they're $1.5 billion. I think those are going to grow a lot faster than even the exchange part of the model. So that's really, simplistically the story. And I think what a lot of people have missed, that it's all about trading and the Bitcoin ETF, and less about these other areas. And those other areas are really what's going to be what drives the revenue growth over the next decade.
Yeah, certainly. We're taking a look at Coinbase up another 5% today. Devin Ryan, always great to have you. Thanks so much for hopping on with us here today. All right, we want to get to some breaking news. The U.S. House of Representatives passing the bill that could lead to a ban of social media giant TikTok. The motion passing with 352 votes compared to 65 no votes. It now moves on to the Senate, where we know, Maddie, you and I have been talking all morning about the fact that this bill faces a much more uncertain future in the Senate, whether or not it's going to be able to pass that and then ultimately get to President Biden's desk. President Biden has said that he does plan to sign the bill if the bill does pass both the House and the Senate. And it's interesting that they were able to do this by such a wide margin, given the fact that earlier this week, President Trump pushed back on a ban of TikTok, saying that he doesn't necessarily endorse it at this time.
Well, and it's interesting hearing former President Trump kind of shift the narrative over to Meta. Having said that, after this went through the House, we are seeing some of those potential plays off this news going upward in the market here. We're seeing Netflix, Meta, and Snap, all names that Angelo Zeno from CFRA, who was on with us earlier, was mentioning could be potential beneficiaries if there were to be a potential TikTok ban. But I'm curious to see what happens next here, because as you mentioned, this has to go to Senate. President Biden has said that he would sign this through once it hits his desk. So it might take a little bit more time for this to fully unfold here. But the last piece that I continue to be interested in is China's response. A China leader saying overnight that the proposed TikTok ban would come back to bite the U.S. What does that mean for U.S.-China relations moving forward when it comes to the financial relationship between these two companies, given that the House did move forward with this vote today?
Yeah, we know TikTok has said that it's going to use every legal tool available to fight this if, in fact, it does pass the Senate as well and is signed into law by President Biden. So TikTok really focusing on the Senate as the House votes to pass this bill here. 352 yes votes compared to 65 no's. All right, keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
The Magnificent Seven in focus this week, also in focus following that proposed ban from the House of Representatives regarding TikTok. Nvidia trading to the downside this morning, giving back some of yesterday's gains. That AI darling, though, still up nearly 80% since the start of the year. But not all Mag 7 members are outperforming. 3 of those Mag 7 stocks seen losses since the start of the year. We're going to get over to Jared Blickery at our Wi-Fi Interactive here. Jared, if you're able, I am curious to see what the market reaction is going to be to this TikTok news this morning. A lot of the names that are located within the Magnificent Seven are obviously going to be part of that, given that they are tech names. But are we seeing any immediate reaction to that news?
Let's take a look at the intraday price action. I would suspect not. Alphabet, not huge TikTok competitor. They do have some social media offerings, but really this is the intraday chart, and there's a little bit of a hiccup down here, but I wouldn't ascribe too much to the TikTok news in particular. Rather, I would expect to see this in Meta, and I don't know the exact timestamps, but you probably see it in there. What I am focused on are the year-to-date returns. As you said, Maddie, Google, Alphabet, one of 3 stocks that has just not been performing very well. Here's Alphabet. It is up for the year, but it's only up 0.3%. You compare that to NVIDIA's 81%, Microsoft 10%. Doesn't really compare all that well, but not quite as bad as Apple, down 11%, or Tesla down 31%. And this is a screen I was showing just a minute ago. This is a similar look, but it's on the market cap gains or losses. And there's NVIDIA, that 81% gain, good for over $1 trillion worth of market cap. Meta, very respectable, $400 billion. Amazon, over $250. Microsoft just behind it. And then you get to Google, Alphabet down $80 billion, Tesla $221, and Apple $358. But let's focus on Google for a second. I want to do a little bit of technical analysis because I am seeing something very encouraging in the chart, not necessarily for the immediate future, but we're getting there. This pattern that we're seeing right here is a cup, and we are just at the very beginning of what potentially could be a handle. And if it continues, it would look something like that, and then it would be off to the races. If you're projecting to the right, that could take several more weeks and months to play out. There could be some back and forth, and there could be some false starts, but I do see this as a likely resolution, which is in the up direction. This is very similar to a pattern that we saw last year in tech and also in unrelated fields like home builders. So it was interesting to see chip stocks and home builders last year emerge from a very similar pattern, and it looks like Alphabet wants to compete there with them. Finally, just want to compare Alphabet to another social media competitor, not on an intraday basis, but on a longer term. You can see Meta here in the cyan has higher highs and lower lows than Alphabet, so it's a much more volatile stock. But Meta itself had a kind of cup pattern, didn't come all the way up, but then it had a consolidation before breaking to the upside. So it looks to me like Alphabet might be one of the laggards. What would the catalyst be? I think it has to be AI. With tons of unmonetized data, they're probably a sleeper for a big rise in another AI company besides NVIDIA this year.
All right, Jared, thanks so much for breaking that down. Again, Alphabet, Google looking at one of the immediate beneficiaries. If, in fact, the bill that just passed the House does pass the Senate, there's been some analyst calls out recently over the last couple of days saying Alphabet, along with Meta, remains one of the key beneficiaries to that. So let's talk about this breaking news that we are getting, that U.S. House voting 352 to 65 to pass that bill that could lead to an all-out ban on TikTok. Rick Newman back on set with us. Rick, we started the day with you, and here we are ending the show with you. So now the big question is how it's all going to play out in the Senate.
It's going to be much harder to pass the Senate than it is the House. And I think part of the reason that it got through the House is this just came from nowhere. I mean, what we know, we're learning now is that there has been an effort underway by some people who really think this is an important national security situation, in conjunction with the Biden administration and the Justice Department, kind of behind the scenes, to sort of mount this sneak attack to get this bill passed in the House. So TikTok and its army of influencers are now aware that there's a problem and there's a real likelihood that this could go somewhere. So I think we're going to see more opposition mounting now that this will hit the Senate. And, the outlook for this actually passing the Senate is, 50-50 at best. And I think the longer this goes on, the lower those odds will become. I mean, let's keep, just to put this in perspective, there was a set of tax provisions that passed the House, I think, 2 months ago at the beginning of 2024. And that was unusual because it was bipartisan. There was something Republicans wanted and something Democrats wanted. That went to the Senate, and it's just stuck there right now. So the same thing could happen here. And it probably also is a factor what Donald Trump actually does, because until just a few days ago, he was in favor of this bill to ban or either force the sale of TikTok. And now he has flipped within the last few days after this guy who owns this billionaire who owns part of TikTok whispered in his ear that this was a bad idea. So is Trump actually going to sort of mount his own campaign against Republicans in the Senate? And if he does, is that going to be influential? My guess is, I don't know if he will, but I think if Trump decides he wants to go to the mat on this, that could be another factor that slows this down in the Senate.
And you have to wonder the appetite to speed it up since we are in an election year, whether or not that's a factor here. We have another guest here with us to discuss this developing news here. We've got Jefferies senior analyst Brent Thill with us. And Brent, thank you so much for coming on. I'm curious about the potential impact here to some of the other big tech names, particularly Alphabet, which we're seeing push into the green after this news. Do you think that because of Google's massive streaming platform and YouTube, is that a potential beneficiary to any potential TikTok ban?
Yeah, I mean, if you look at my own kids, they're split between TikTok and YouTube. So, certainly, if it was shut down, the place you're going to go is probably on YouTube, and the advertisers would flip over. So Google could be a beneficiary. Obviously, Meta and Pinterest also could see more time spent on the platform if that happened. So yeah, certainly there's going to be beneficiaries under the scenario that it does get banned from that side. I mean, certainly Snap could see this as well. If you look at most of the younger audiences, obviously they go back and forth between Snap on the map and then some of the videos on TikTok. So those are all potential beneficiaries. Again, at the low end, it's probably more of a Snap, and at the higher end, it'd probably be more a Google beneficiary.
Brent, from an analyst perspective, when you take a look at the vote that was today, yes, we have to wait to see how this all plays out in the Senate, but how material of an impact is this going to have on a name like Snap? Obviously, you're saying it's probably best positioned here, but in terms of the bottom line, what does that more specifically look like?
Yeah, I mean, it's hard to say right now because we don't know exactly what's going to happen. But if you think about what's happened right now, most advertiser budgets have shifted to Meta. So Meta has gained, 30, 40, 50% of the incremental budgets. And it's because the quality of the product, and they lapped the iOS privacy change. You've seen in all of our advertising work, the ROI on Meta is off the charts. So if you just look kind of in isolation of what's happening away from this, Meta has been the biggest share gainer, and is one of the fastest growers. And as they've said, they have 3 billion people on the planet. They have multiple ways to engage with their platform across the different products. So we continue to believe that Meta has the best fundamental position in social. Snap, on the other hand, has really done a terrible job. I mean, they again, when you talk to the younger audience that is on this platform, they use it for the map to see where their friends are, and they use it for a messaging system because they don't want their parents to see what they're sending. But they're not influenced by the advertisement. They're not influenced by the shows. They're not influenced by anything else on the platform. And so that's why you're continuing to see they've got users, but they don't have the advertiser activity that Meta has. And so they've got to fix that. Now, if TikTok got banned, could theoretically this really help Snap, and could this be a windfall, for them to but again, I think they have to fix their own house on some of the issues before that really improves.
Right, and Brent, we have to mention, of course, that this still does have to go to Senate, where it is likely to stall, given the wide variety of factors that we've talked about here, particularly one of them being this election year, so a lot of policy on the table there. Brent Thales, thank you so much for joining us to break down that breaking news, and our thanks to Rick Newman, who had to go cover this developing news, so he had to leave the studio here for us, but we appreciate him as always. That's going to be it from myself and Shauna for today. Rochelle and Akiko have you for the next hour.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akutho alongside Akiko Fujita. Here's a look at what I'm watching this morning. The U.S. House passes the TikTok bill with a potential ban of the popular social media app in sight, but the path ahead could be more challenging as it heads to the Senate.
NVIDIA giving back some of its gains from earlier this week. Wall Street bracing for the company's upcoming tech conference. We're going to break down investor expectations for the AI darling.
And weight loss drugs, the darlings in healthcare. Latest innovations from Novo Nordisk and Eli Lilly fueling the healthcare sector rally this year. But what's the best way to play the space? Find out later this hour.
First, though, let's do a check of where the major indices are trading 90 minutes into the trading day. We've seen the S&P 500 slip off of that record that we saw set yesterday's session. The S&P 500 trading down about 6 points there. The Dow up 134 points and the Nasdaq down 88. Tech seeing the biggest losses on the day so far in the session. We've seen some of the names in the energy sector seeing the biggest gains so far. Let's do a quick check of where Treasury yields are on this Wednesday. Taking a look across the curve here, the 10-year yield at 4.17% and the 30-year yield at 4.34%. The big story, though, we are watching this morning, the U.S. House of Representatives passing a bill that could effectively ban the popular social media app TikTok.
On this vote, the yeas are 352, the nays are 65. One present, 2/3 being in the affirmative. The rules are suspended. The bill is passed. And without the objection, the motion to reconsider is laid on the table.
Officially named the Protecting Americans from Foreign Adversary-Controlled Applications Act, the bill requires TikTok's parent company ByteDance to divest its U.S. operations within 180 days to a buyer that is not from a foreign adversary country. Essentially, a non-China entity is what we're talking about here. 6 months is what we're looking at right now. Already, let's see, Beijing has already said it would firmly oppose any forced sale of TikTok. And, you know, Rochelle, we should point out how quickly this has moved. As we know, things don't move very quickly in D.C., but last week, the House voting to push forward the bill here. Today, the vote coming through. The final tally here, 352 to 65. So not necessarily a unanimous vote, but we knew that it would go through the House here. The big question is going to be what happens here in the Senate, because senators have expressed some skepticism around the language of this bill that has gone through from the House. Maria Cantwell, who chairs the Senate Commerce Committee, her office telling me yesterday that she really wants to find a path forward here that is constitutional and protects civil liberties. And that's certainly going to be the key debate. What does it mean to ban, effectively ban, we should say, because it's not necessarily a ban, one specific entity, one specific company? What kind of precedent does that set for other apps, other companies moving forward?
And it's true. And I think one of the criticisms that was even raised by TikTok executive Michael Beckerman, he wrote to Congress on Monday saying that the bill raised serious constitutional concerns. So we'll see how that stands up to legal scrutiny when it comes to the First Amendment protections, but also being rushed through at, quote, an unprecedented speed without even the benefit of a public hearing. And you figure the influence not just of your typical lobbyists when it comes to certain issues, but also the influencers who have also descended on DC as well and not really having that chance here. It'll be interesting to see then what happens in the Senate, a slightly different dynamic as well. And as we look at some of the key measures in the bill, it really focuses on the foreign influence of apps, some of these national security risks by collecting data, the potential to spread misinformation, some of the presidential powers potentially giving the president authority to identify and take action against some of these apps if they are considered an adversary, which, you know, depending on the geopolitical environment, that could change from one country to another. The divestment requirement, as we mentioned there, and as we always will talk about, the focus on user safety, how this data is being used, and really looking for more proof on some of those adverse effects that they're supposed to be protecting American users from. Well, with that in mind, the U.S. House of Representatives passing that bill that would force the Chinese company ByteDance to divest from the social media giant TikTok. Joining us now on the implications of this legislation are Shahzad Kazi, China Beige Book International Managing Director, and Colin Costello, Freshfield's CFIUS and National Security Advisor. Welcome to you both here. Now, obviously, going into this, when we saw that House panel first have that, no opposition to this, we did expect it at least to still have that support in the House. Shahzad, I want to start with you, though. In terms of the support that we might see then as we head to the Senate, is there the same appetite for this here?
Well, definitely not. The House, it was very clear that this was going to pass given the amount of work over the last year and a half that the Select Committee Chair and Ranking Member Mike Gallagher and Raja Krishnamurthy have put in behind the scenes. The Senate is a different ballgame, and it's pretty much up in the air right now whether it passes. I think how former President Trump potentially changes his stance, if he softens up, I think it has a good chance of passing. But if his opposition remains firm, this may just die in the Senate.
Colin, this is something that you're very familiar with, given your involvement during the Trump administration. I realize you can't weigh in specifically on the ban that was proposed under that administration, but at the core of the debate over the years with TikTok, it has been about the national security concern, the data collection that happens on the app. Is this about evidence that points to the Chinese government having used that data, or is it about the potential risk that could come with allowing that? In other words, there's not necessarily the evidence, but the potential of that is really high.
Certainly. So if you look at how the government understands national security risk, it really looks at it in terms of three variables. Those are threat, vulnerability, and consequence. And so the threat is going to be the foreign person, in this case, ByteDance. The vulnerability is going to be some aspect of the U.S. business, the U.S. operations of TikTok that might make it susceptible to exploitation by a foreign adversary. And then the consequence is how those two variables are going to interact with one another. And here, given that depending on whose estimates you believe, TikTok has between 150 and 170 million U.S. users, that consequence of exploitation could be potentially quite enormous. So previously, the focus seems to have been on reducing the vulnerability of TikTok. This is what has been done by TikTok in terms of what they call Project Texas, working with Oracle. But apparently, the Congress has determined that that's not moving fast enough. And so they're going to now try to address the threat aspect of this, which is to say they are going to force ByteDance to divest TikTok or else face effectively a ban in the U.S., thereby removing the threat actor. And I think from the perspective of the government, whether or not they have access to classified information that suggests that this app has been used by the Chinese government to obtain information, the latent capability exists simply because the Chinese government does have broad legal authorities to compel cooperations in matters of national security. So from the perspective of someone who views the Chinese government as an adversary, and as a very capable adversary, the question is not has it been used, but can it be used? And the answer to that, I think, from the perspective of the people who wrote this bill, is yes.
Colin, let's suppose that this bill does, in fact, pass the Senate as well. And that's a big if, obviously, the way Shahzad has laid it out. What are the legal challenges or legal avenues that TikTok can fight this?
Well, certainly we saw the challenges that were brought against the 2020 executive order by Donald Trump, which was promulgated pursuant to the International Emergency Economic Powers Act and ultimately fell because it ran afoul of the personal communications exception and the informational materials exceptions. This bill is really designed, I think, to get around that. The IEPA is quite flexible in terms of a grant of authority, but it's not infinitely flexible. And certainly the courts found that in relation to the 2020 executive order. What this is doing is providing effectively an independent authority for the executive branch to review foreign adversary controlled applications, so defined, and effect a divestiture if they find that they represent a threat to national security. Other challenges obviously could be brought under the First Amendment of the Constitution, and I think that will likely turn on the extent to which this is viewed as content neutral.
And Shahzad, I want to bring you in here because when you think about retaliation, I mean, the Chinese government has already said it does not support this divestiture. Could we be stuck in a tit for tat? And what would be the most likely targets? Something perhaps that would be the equivalent of, say, a TikTok in China?
Yeah, pulling back, I think the idea is that in Beijing now, you have what I like to call a minus America policy, which is where, when it comes to things like supply chains, et cetera, we talk about having a China +1 strategy. China shouldn't be the only provider. But when it comes to the Chinese government, especially in the area of technology, whether it's hardware, software programs, so forth, but beyond technology too, they want American businesses and American providers completely extricated. And of course, in China, we have a very broad, developing definition of what could potentially construe a national security threat. It's very unclear, which means that a bunch of targets are open for retaliation. Of course, the social media companies don't exist out there, American ones, essentially, so they're out. But, it's very likely that they go after some kind of high-profile target, nevertheless, in maybe a different industry, maybe a different space, and not necessarily a direct equivalent, such as in the tech space, as they've done in the past when they went after Bain, etc. So I think some kind of high-profile target or retaliation is absolutely going to be in the cards to the extent that this becomes all successful and we're able to take on ByteDance and perhaps if TikTok is banned.
And Colin, obviously, what counts as a national security risk, obviously that's something that can be subjective. But what about the idea that perhaps some of the concerns here can't be addressed any other way other than divestiture or a ban? Will that stand up to legal scrutiny?
It's difficult to say. I mean, the purpose of the law is supposed to be narrowly tailored to address the specific national security risks that would arise from the foreign adversary control over the application in question. Here, the attempts by the Congress is to make certain that when this is, or if this is challenged, I should say, and I think when this is challenged, that they can demonstrate that this is motivated by a specific national security risk. It is narrowly tailored to address that risk. As we've been saying, it is not a ban, effectively, or per se. Rather, it is just a choice. It is a choice to divest or die, effectively, not be able to distribute your product within the United States. And I think in trying to characterize it there, as opposed to just as a direct ban of a particular and specific product, the Congress is hoping to avoid challenges that might arise on the basis that it is not narrowly tailored enough to the specific risk that's been identified.
Shahzad, you mentioned the potential for retaliation against American companies. I can't help but think about what's been playing out with Apple and their iPhones. When you hear the language that is coming out on why government employees have not been allowed to use it, it's very similar, right? To say that it's an American company, they could potentially have a backdoor, they could potentially be collecting data on Chinese users. How does the Chinese government deal with this at a time when they are trying to attract more foreign investment into the country, when things have slowed down? It's sort of trying to find this balance between countering what the U.S. is doing, but at the same time saying we're still open for business.
Yeah, I think I would say this is classic China policy. It's asking for foreign investment in areas where China needs the foreign capital, or more importantly, needs the foreign know-how. Think of any number of chip makers, the equipment they supply, or anything related to semiconductors. But in other places where China has been able to successfully help homegrown companies through a range of subsidies and policies help and become powerful and take on the foreign companies, and the competitors as they're seen now, China's more than happy to, increasingly get rid of them. So we've seen this play out over the better part of the last 20 years.
Finally, Colin, you say that there hasn't really been a precedent for something like this. When you think about the way in which Congress is trying to take this action to effectively ban TikTok, what would be the legal implications? What's the fallout from this beyond TikTok? Because there are plenty of apps out there. There's plenty of Chinese companies that are looking to make entry into the U.S. and other foreign countries or other foreign companies as well.
Certainly. I mean, the TikTok is the focus right now because it's the shiny object, but the bill is much broader than just TikTok. TikTok is just the example that the bill puts forward as sort of the first use case of the legislation. If passed as written, this would grant the president a very broad authority to identify sort of so-defined foreign adversary controlled applications ranging from websites to mobile apps to desktop apps, and then with a degree of notice, force a divestiture. There are questions here in terms of what does this mean for companies' willingness to host applications that are coming, for example, out of China, if they fear that perhaps in the future they're going to be deemed a foreign adversary controlled application, and now the company who's hosting that application is going to face potential fines, potentially enormous fines, if they continue to host the application. I think there's also implications for open questions about CFIUS jurisdiction. If CFIUS has reviewed, for example, a foreign acquisition of a U.S. business and cleared it, it's cleared it with safe harbor, which means that CFIUS can't re-review the transaction. I think, as written, there's an open question as to whether or not a CFIUS grant of safe harbor could effectively be overruled by this bill, by the president making a finding under this law that a foreign adversary controlled app poses a threat to national security, even if CFIUS in the past has previously reviewed and cleared a transaction, the president could then come over the top because it's not being conducted under a CFIUS authority, it's an independent legislative authority, and effectively force the divestiture that CFIUS has already approved. So I think that there's a lot of open questions here and potentially much broader implications just beyond TikTok.
Okay, we'll be watching all these developments play out. Great to have both of you on today. Shahzad Kazi and Colin Costello. Appreciate the time. Well, coming up, are higher rates for longer actually a bad thing? We're going to talk to a strategist on why it may not be. Stay tuned. Time now to take a look at today's trending ticker, and we're looking at Williams-Sonoma hitting a record high today after reporting its Q4 earnings, beating the street's expectations. The homewares retailer boosting its dividend and stock buyback as well, raising that dividend by 26%, setting a new $1 billion share repurchase program. This is a stock, Rochelle, that has absolutely outperformed its peers. The stock up about 40% year to date, certainly seen a big bump. And interesting to hear the company saying that they really did compete here. They saw the big drive gains in the quarter on the back of full price selling. We hear a lot about discounts, but full price selling here, along with supply chain efficiencies, pointing to a mid to high single digit annual net revenue growth they're expecting here, at least in the long term.
I mean, and especially when you think about the backdrop here, we saw CEO Laura Alba saying that we outperformed in 2023 despite the slowest housing market in several decades and geopolitical unrest. So when you have that macro backdrop and you see a company like this able to really slow some of the bleeding that they saw, this was their third consecutive quarter of slowing earnings declines. It ended its three-quarter streak of accelerating sales declines. So clearly a lot to like here. And of course, with that 26% dividend raise and a new buyback plan, along with that earnings beat, certainly a lot to like in this story, especially, you know, Williams-Sonoma, not the cheapest price points. It's not something that the average person, it's a bit tight on the pockets here. So interesting to see that they're still able to pull ahead here, and clearly the stock price being rewarded for that.
Yeah, maybe also, a very store-specific or brand-specific story as well, as we've seen, sort of the broader retail space talking about more discounts and talking about a more cautious consumer. So story that we're going to continue to watch there. Today, NVIDIA giving back some of its Tuesday gains. This comes as Wall Street braces for the AI darlings, a tech conference, GTC. That's happening next week. Investors are hoping the company can show off its AI innovations, serving as a catalyst for the stock. To break down what the street is saying, we have Yahoo Finance's very own Jared Blickery. Jared, do we need any more catalysts after the run this stock has had?
I'll tell you what, when we have these investors' days, and this I think counts as one, the GTC that event that we're going to have next Monday is just huge. Lots of excitement over it. Not surprising because NVIDIA is one of the top performers of the year. And over the last 2 years, AI is a story. And NVIDIA is no stranger to volatility. You mentioned that 2-day slump. That would be from this high here all the way down here. That was the worst slump in days. However, that was overcome yesterday, and we're giving back a little bit today. But the bottom line is, over the last 2 years, I think this gives a really good picture. Here's what we've done this year. Here's what we did last year. And in fact, for about half of last year, that was the back half, we were stuck in a trading range at the upper end, just short of $500. Guess where we are now? We're just shy of $1,000. So when the price is heading towards these big psychological levels that have never been hit before, they can act as a magnet, but also as resistance. And so when we think about catalysts, this is a big one next Monday. The event is going to start at 1 p.m. It goes till 3 p.m. That's post Pacific time. So we're talking about 4 p.m. after the market event. But stocks will be trading in the after hours, and we'll have to see what the reaction is. They're going to be introducing their new Blackwell architecture and a new chip that would be the RTX 5090, which has double the throughput, double the bandwidth of the RTX 4090. All of this to say that there's a lot more to come in the chip space from NVIDIA, specifically to address the needs of this hot market right now. And I will close here by just comparing NVIDIA to some of its peers. This is year to date. NVIDIA, a very impressive 80.5%. You compare that to Super Microcomputer. I'll show you a 2-year chart similar to what we saw before. Well, that's up 2,700% in 2 years. No idea if they're having an investor day, but I would expect to see them moving Monday afternoon as well.
Indeed, certainly another beneficiary of the generative AI push that we've seen. Appreciate you, as always, our very own Jared Blickery. Well, we're looking at inflation data coming in hotter than expected this week, still well above the Fed's 2% target, moderating expectations of rate cuts coming anytime soon. But our next guest thinks we should be careful what we wish for. More on this, Mahoney Asset Management CEO Ken Mahoney is here with more. So for people who are wondering here, it's not just about the rate cuts, it's why the Fed would be cutting the rates. Break that down for us.
Right. Be careful what you wish for. Remember, October was at end of October. We had that spooky month. And because we're talking about keeping rates higher for longer, that's what the Fed told us, and then capitulated about a week later, following the bond market the way we look at it, and said, oh, forget about that higher for longer. We'll probably be cutting rates in 2024. And then it was like a bidding war. I got 3 rate cuts. I got 6 rate cuts. Listen, the last thing in the world you want is 6 rate cuts because that's a company with slower growth. I think we're in this Goldilocks environment right here, believe it or not, because we have great earnings. The headwinds, no doubt, are there. There's always some things you have to deal with. But be careful what you wish for. If you have 3, 4, 5, or 6 rate cuts in this year, 2024, from where we are now, I wouldn't like to see what the economic numbers were to precipitate that. So anyway, I think maybe get 2, but be careful what you wish for here with all these many rate cuts.
Ken, I'm surprised to hear if there's anybody out there that are still calling for 6 rate cuts, given where we are with the economic data coming through. But we're still looking at a potential for a June rate cut. With that in mind, what do you do with your portfolio?
Right. So I think if they do cut in June, it's kind of insurance. I think they knew when they're raising rates, the first part of it, 11 times, they raise rates, and then we kind of maybe take a couple back to make sure we can balance out and so forth. I think too many people are getting hung up with the economy. Again, of course, we have to look at GDP. We have to look at inflation. We have to look at rate cuts. But right in front of us is one of the biggest opportunities we've seen. I mean, really, it's a tale of two markets. It's technology and everything else. And it reminds me in the mid-1990s when, the birth of the internet, we all ran out to get PCs. What investors don't see here, unfortunately, in their own naked eye, they don't see these servers. They don't see like warehouses of servers being bought. It's not that tangible. But what we're seeing is probably one of the biggest capital expenditures in the history of the market. So I say that it's really important that don't get caught up with how many rate cuts and what the Fed's doing. Again, really focus on some of these growth companies that you can make significant progress with. And that's kind of our forte is, again, we are growth managers. We certainly want to stay away from falling tops and doing all these type of things. But in front of us, we have a really nice runway to make some good money here.
And we're still seeing this bull market continue. Obviously, some jitters around some of the inflation data that has come out. But when you're looking at Q1 earnings being the next catalyst, what are you looking for in that that's really going to give us a better idea of how investors should be looking at what's going to be happening in the next few months?
Right. So we look for those companies, our playbook, every earnings season, and this one, March 31st, and they'll start reporting third, fourth week in April, is kind of buy those companies that beat and raise guidance. And that's, if you follow that money that way, you'll see all these big moves from Meta. Remember, Meta had so much in earnings in the December quarter that they end up buying $50 billion worth of stock. So a lot of good things happen. So here's what happens. They beat, they raise guidance. Wall Street or analysts go from holds to buy or buy to strong buy, $110 targets, $160 targets. You get all that good stuff. By the way, just the opposite. Stay away from those companies who miss. I know it's tempting because stocks go lower, that miss, and then guide lower. You're in quicksand, you're missing the opportunity. So I think this quarter, which will end March, I think it's going to be great for technology shares. And I think we'll still continue to prove that we're in the early innings of AI. By the way, the CEO in the video said we're in the second or third inning. So we still got a long runway here. But again, I suspect this first quarter's earnings are going to be very strong, especially for big tech.
We'll certainly wait to see what that seventh inning stretch looks like when we get to that point. I appreciate you joining us, Ken Mahoney, Mahoney Asset Management CEO. There you go.
Take care.
All right, you too. All right, coming up, sky-high auto insurance is taking a toll on consumers. We'll discuss with an expert coming up next.
Well, the cost of driving remains high, according to the latest CPI report from the Bureau of Labor Statistics. Auto insurance prices remained up by 20.6% from a year ago in February, the largest jump in government data going back to 1985. For more on what this means for consumers, we're joined by Doug Heller, Consumer Federation of American Director of Insurance. Doug, good to talk to you today. You know, I'll admit, yesterday when I saw that CPI print specifically on transportation services, it made me do a double take because of just how high the jump has been. What's been driving those price gains?
Well, it's a series of things that some of which are expected. The supply chain crisis coming out of the pandemic created some difficulties, especially for new vehicles. Repair costs have been going up, but as you just showed, those numbers are starting to come down, and there's not nearly as high as inflation. And what's happened is the insurance companies have fallen behind the inflation curve, and they like it there, right? Because they're setting their rates as though inflation were still at that level that we were seeing in 2022 and in the beginning of 2023, when they were really skyrocketing throughout all industries. But as other inflation has come down, they've kept those premiums high, and those high premiums are still flowing out into consumer pockets. We've seen an additional tens of billions of dollars in consumer premiums for auto insurance over the last 18 months or so. And it really doesn't fit with where the direction of inflation is going. But with insurance, it's not really a competitive market in the same way that most others are. Consumers have to buy the product. We're stuck with whatever they give us. And so as a result, we're seeing this kind of misalignment between what the insurance industry is doing and what the rest of the economy is showing.
So then, Doug, at what point then could we expect some sort of normalization when the lag that we've seen with auto insurance catches up with the rate of what we're seeing with everything else starting to decline as well?
Well, that's one of the real big problems that consumers face, because these rate hikes that get put into place, they roll out over the course of policy years. So we have people who still haven't even seen the rate hikes that were announced in, say, January, December, even back into November, because their policy hasn't renewed yet. So I expect that we're going to see another at least 6 months of people feeling the rate increases that have been announced over the last several months before we even begin to see relief. But perhaps more of the problem is that the insurance industry kind of is in charge here. And because they've got that captive market of consumers, we find that they are really slow to pull back on their rates. And it's, this is kind of in sharp contrast to what we saw during the pandemic. Everybody remembers being stuck at home, not driving. We weren't crashing cars either. But other than a little bit of a give back that the insurance companies provided right at the beginning of the pandemic, when they gave back 10, 15% of a month's premium or two, they really did not lower rates, not significantly, when things were going really well for them. But the moment that inflation hit with those supply chain problems and repair costs going up, they were very aggressive and very quick with rate hikes, these extremely high rate hikes that we've not ever seen before. As you pointed out, this is some of the highest inflation in a generation. And so they were really slow to give back money when things were really going well for them. They've been really aggressive to take money in the intervening years as things have gone up. And another reason to add to this is that they had a bad year on the stock market in 2022 with the rest of the world, right? And their investments are such a key driver of profitability that, they take our premium, they call it the float, they take our premium and then they invest it. But when they have a bad year, then they need to go grab more premium. So it was sort of their bad luck in the market, bad decisions, bad investments. They weren't alone in that, but that also has been a driver of things. And so they've been trying to capture back a lot of those losses on our premiums.
So Doug, we're talking about 6 more months of rate hikes, or at least elevated rates for insurance. What does that ultimately mean for the consumer? We've already heard reports of drivers who are saying, well, if that's the case, I can't afford insurance, even though I still need to drive.
Well, that's really what's really concerning for us at the Consumer Federation of America, and for anybody who's getting on the road to drive. With cost of insurance going up, people have to make these really tough decisions because you're required to buy insurance, but you've got all these other costs. And if you're sort of a moderate income person and you see these 15, 18% rate hikes on your monthly insurance bill, you're starting to make decisions. Sometimes you're cutting back on the coverage that you have, so you might not have coverage if your car is stolen because you get rid of that comprehensive coverage, or you may have lower liability limits, so you may not be able to pay for enough of a crash you caused. But even worse still, we're really concerned that we're going to see an escalation of uninsured driving in America. So either people are going to be, reducing their coverage, which is going to potentially hurt them, or they're going to be going uninsured, which not only puts them at risk of being held criminally liable for driving uninsured, but puts everybody else at risk for crashes that go uninsured. And when that happens, that means, all of us pick up the rate that costs either in our own insurance premiums or taxpayers pick it up in public health costs. So either way, this is a vicious cycle of when insurance rates go up. And the fact that they're going up beyond what they need to be now, that they haven't slowed down when they should have, is a real testament to the weakness of the regulators who really are supposed to be protecting consumers from exactly this kind of a problem. So we have a situation right now where customers of insurance companies are really in crisis. And we're hearing about from people all around the country about this. And at the same time, if you look, several of the companies, Allstate, Progressive, Travelers, have seen all-time stock market highs over the last month. So there's a real problem when the companies are seeing share price, tipping, top, and at the bottom are consumers who are struggling with the prices. And that's a real problem that we're facing. And we're really worried about what happens on the street when people are driving uninsured.
It's true. It's certainly a decision you don't want to have to make between being able to protect yourself and your car in situations like that. Perhaps it will draw the eye of the Biden administration, who's also been very focused on some of these inflated prices in other industries as well. Appreciate you taking the time to join us. Doug Heller, Consumer Federation of America Director of Insurance. We appreciate your time this morning.
Thanks for having me.
All right, coming up, we'll dive into the healthcare sector. What you should know as you navigate rising prices and the weight loss trend. That's next on the other side of this break.
Well, inflation remains a consistent issue for Americans. So we saw that in Tuesday's CPI report. One way it's impacting consumers is surging costs for over-the-counter drugs. Let's bring in our very own Anjali Kamlani to give us the details. Anjali, we were just talking about insurance rising as well, but what's behind the gains that we have seen with some of these drugs?
Yeah, so surprisingly, we saw over-the-counter or non-prescription drugs see a year-over-year surge of 9.3%, which you just saw on your screen. And that is because, in large part, due to, and this is going to sound funny and redundant, but inflation itself. That has been one of the underlying reasons that some providers gave me. So if you see on your screen right now, the non-prescription number, 9.3% year-over-year. Meanwhile, prescription drugs, such a big conversation around that when we talk about branded drugs and the inflation that you typically see there, the spikes in prescription drug pricing, just 0.3% year over year. And it's important to know that actually from January to February alone, the jump for non-prescription was just 0.4%. So the big jump happened over the last year. And that is really a result of things like increased demand, manufacturing, labor costs, as well as inflationary pressures. That's what some of the makers of these over-the-counter medicines, as well as pharmacies, have said in the last year. You've seen it pop up in earnings reports over the past year that they're contending with some of these issues. Take a look at Bayer in their Q3 statement last year saying, quote, "We were able to offset the decline in volumes and inflation-driven rise in costs thanks to our continuous cost and price management efforts." So there you have it, very clearly saying that prices had to rise. We have seen in recent reports, especially end of year and Q4, that those inflationary headwinds are starting to relax, including because of the investments made, maybe in increased manufacturing and the labor there. So we should be seeing that sort of taper off in the next couple of months or so, but all eyes on that just to see how it goes.
I certainly hope so, just in time for allergy season as well. Appreciate you as always, our very own Anjali Kamlani. Well, staying in the healthcare space, according to S&P Global Market Research, investor risk appetite appears to be improving in February as markets digest better growth prospects in the US economy and easing recession risks. Now, leading the way are healthcare and tech sectors. The latest innovations in obesity drugs with Novo Nordisk and Eli Lilly's GLP-1s fueling the healthcare sector rally so far this year. So what are the best ways to invest in healthcare and weight loss related stocks using ETFs? Well, as part of our ETF report brought to you by Invesco QQQ, let's bring in our next guest, Yuri Kojimirian, Tema ETF's Chief Investment Officer, to discuss more. Thank you for joining us this morning. So I want to first start with the latest here, which was the FDA's approval of Novo Nordisk's Wegovy to treat heart disease. So another one of these additional benefits of this weight loss drug that actually was started off as a diabetes drug here. What does this open up then in how people can invest in this space?
Yeah, I mean, look, it's great to see the FDA approve it off the back of essentially data that Novo Nordisk delivered back in the summer, and then the full data readout sort of November, December last year. This was a major trial. They took 17,000 patients, 5 years, and what they showed was a 20% reduction in the risk of major cardiovascular events. So for the first time, we're starting to see real evidence that weight loss drugs actually benefit patients. And this is going to be a big deal in terms of payers. So you're going to see Medicare, for example, start to look at covering these drugs, which historically they haven't done before. And similarly, other insurance companies and countries around the world are going to sort of have to sit up and pay attention when you're saving people's lives with these drugs. So it was a bit of a major move. The FDA announcement was expected because the data was so strong, but this is really helpful in terms of getting weight loss drugs over to patients.
So Yuri, for those who are following this weight loss drug trend, how do they invest in it through ETFs?
Yeah, so at Tema, we have an ETF called HRTS, that's the ticker, and it's basically investing in obesity drugs and obesity-related areas, as well as other cardiometabolic areas. This is a fantastic space. There's been a huge expansion in different opportunities and different types of companies. You've got your stalwarts like Novo Nordisk and Eli Lilly, which have been leading the way, but there's a whole host of new companies that are coming behind with better and newer treatments in terms of weight loss and other types of cardiovascular disease and diabetes. So this ETF is a great way to get exposure to the obesity and weight loss trend.
So Yuri, what are some of the characteristics that people should be looking for within ETFs here? Because obviously you can get a flood of companies here trying to jump on these obesity trends as well. What are some of the things that you specifically look for?
Yeah, absolutely. I think it's extremely important that you're selective. The first thing is that you need to have a precise exposure of the theme, right? So We want to make sure that the companies that are under the hood in the ETF are actually the companies that are going to be winning the way forward in terms of forward-looking winners rather than backward-looking winners. A lot of the times you see in ETFs, you have the historic winners rather than the future ones. The second thing is continued innovation from these companies. And innovation is really the lifeblood of the healthcare sector, and you want to be seeing that within the companies. As you know, HRTS is actively managed. We have a portfolio manager who spent 25 years in industry. He's an MD, PhD. He's got a ton of expertise looking at this space. And he's spending his time looking at who is going to be the next winners in the weight loss revolution and constantly adjusting our portfolio to make sure that we're aligned that way.
Finally, Yuri, broader healthcare. We have seen huge gains across the board here. Just talking about the S&P Global, Investment Managers Index, also very bullish on healthcare. That's the top sector there. For those investors who have not gotten in yet, what are the key entry points they should be looking at? Is it too late?
That's a great question. So in terms of life sciences and healthcare in general, we've actually experienced quite a torrid bear market, probably over the last 2.5 years. And it sort of bottomed at October last year. And we've seen a rally in biotech shares. And now what we're seeing is a real kind of green shoots. You're seeing M&A activity pick up. You're seeing IPOs being done. You're seeing even secondary private placements of stock. All of these are healthy signs that the market is healing in terms of biotechnology and healthcare sectors. And so, yes, you've had a rally, but we're pretty much back to where we were relative to the levels of last summer. And so what that means is we think that there's quite a lot more to go. Maybe there'll be a space for consolidation. But if you look at areas like weight loss and obesity, there's a lot of growth. I mean, these are huge, huge markets. Novo Nordisk estimates there's 800 million people living with obesity today. By some estimates, it's actually 1 billion if you include children and adolescents. And that number, the World Obesity Atlas forecast, is going to grow to 1.6 billion by 2030. And only about 1 to 2% of those are actually on any type of medication. So you can see that there's enormous potential. And it's that growth that's underlying why we think that there's a lot more potential going forward in this space. And if you couple that with innovation, which is constantly happening and has been happening despite the bear market, we think healthcare and life sciences particularly are an exciting place to be.
Yeah, that's a lot of billions you put there in terms of potential. Yeah. Yuri Kochimirian, Tima ETF's Chief Investment Officer. Good to talk to you today. Appreciate the time.
Thanks for the time. Thank you.
Well, coming up, we're turning our eyes to retail, how businesses are handling theft. More of that after the break.
As this earnings season comes to a close, major retailers like Target and Ross stores are still citing shrink or a loss to any inventory as a headwind. Yahoo Finance's Brooke De Palma dug into all the earnings reports from this cycle to find out how the shrink problem has evolved. So, Brooke, what did you learn?
Good morning, Rochelle. Well, in the latest round of earnings, the concept of inventory shrink, that loss of inventory to theft, error, fraud, or damage happened in a handful of calls. And one of the companies that weighed in on it the most was the one that publicly took the most precautionary steps. That's Target. The retail giant shared that it had to close 9 of its stores last fall, claiming that it was due to high theft rates. It also implemented locked cases, like you could see on screen, and increased security. But on its earnings call, CEO Brian Cornell shared that last year, the cost of shrink jumped more than, get this, $500 million compared to the year prior. Target also said that since 2019, shrink costs have reduced its operating margin rate by a cumulative 1.2 percentage points. It said that it's seeing some encouraging results, though, from the actions taken and now expects the shrink rate to remain flat this year compared to 2023. And another retailer, COO of the discount retailer Ross Stores, also said it is not immune to external theft and the organized crime environment throughout retail. As it saw consistent shrink levels last year, it now plans to invest in initiatives to deter shrink, but baked in an expected higher shrink rate into its 2024 guidance already.
Now, heading into this earnings cycle for season 2 of our series next, Yahoo Finance's Madison Mills visited a research lab that develops and tests theft prevention technology for retailers. Maddie, how does this differ from what retailers are already doing right now?
Well, Kiko, in our upcoming episode of Next, we got to look at how retailers are investing in AI-powered technology that's brand new to help fight an existing problem with theft. We were given an exclusive look at one of those technologies. We visited the Loss Prevention Research Council, which houses over 400 of these brand new tools within the University of Florida. Here's a look at what we saw.
Retail theft like this could be prevented with new AI-powered technology. This lab develops and tests new tech that aims to curb theft. And over 80 companies who traditionally compete, from Target to TJ Maxx, are coming together to fight that theft, investing in AI-powered tech like this live heat map. This dashboard pulls information from retailers, law enforcement, and fire rescue agencies to paint a clearer picture of where and when crime happens.
It's allowing us to better understand the dynamics, the ecology of crime, who's doing it, where are they from, who are they linked to, why are they picking certain places and not other places.
What's next for the map? An alert system where stores would get a ping if any nearby retailers experience a crime event. The Loss Prevention Research Council plans to expand its footprint with retail partners in Atlanta, Albuquerque, and beyond. Experts like Reed say retailers coming together on technology like this could make retail theft a thing of the past.
And this isn't just getting attention from the retailers themselves, it's also getting legislative attention as well. Right here in New York, Governor Kathy Hochul announcing $45 million in funding to prevent retail theft, $5 million of that just in potential tax provisions for small businesses to invest in AI-powered technology as well.
All right, appreciate you, Madison Mills, and our very own Brooke De Palma as well. Of course, be sure to tune in this Monday at 4:30 p.m. Eastern to see the Season 2 premiere of Yahoo Finance's series Next, taking a look at how AI-powered technology can help prevent retail theft. Don't want to miss that. Right, well, before we go, let's give you a quick check of how the markets are doing heading into the noon hour here. Still looking at a mixed picture here. The Dow, the only one reaching for daylight here, currently up about 150 points. Still seeing some volatility in the S&P 500 there. Tech, the biggest laggard there, the only sector in the red there. Energy leading the way. And then looking at the tech-heavy Nasdaq there, taking the brunt there, down more than 0.5%. Well, that does it for now. I'm Rochelle Akufo alongside Akiko Fujita. Thanks for watching Yahoo Finance.